Thank you all for joining us here today. Good morning. My name is Melissa Coity. I'm the Deputy Director of the Asset Building Program here at the New America Foundation, and I direct our financial services policy work, which is funded by the Ford Foundation. I want to thank you all for coming here today to talk about the other world of shadow banking. I hope there aren't too many of you who are in here thinking that we're talking about hedge funds and private capital pools. I think there may be at least one. But I think you're going to get a lot out of the conversation, and this is really a relevant conversation in this time of broader issues around re-regulation and the financial services policy discussions that are underway. We are here today to talk about the underbanked. Who are these consumers for these non-bank financial services products? Many of you probably know, but these products range from prepaid cards to check cashing services, money orders, small dollar loans, refund anticipation loans. And estimates are that there are as many as 40 million households or over 100 million individuals who are using these products to meet their daily financial needs. They may or they may not have a bank account. It's a really dynamic issue, but they are turning to these products in order to get to meet those daily needs. While the non-bank products are clearly meeting a demand, and we're going to hear a lot about that from a really interesting panel of experts, a recent study shows that the cost really can vary by product from provider to provider. A recent study by the Center for Financial Services Innovation showed that monthly transaction fees for the same transaction with one provider cost an individual $10, but at another provider it was $100. So real variability. Depending on the product, there are a host of reasons why we see variations in consumer protections with some of these products, and that's clearly a topic for today's discussion as well. We've got a lot of variability. These products are regulated at the state level. There are variations in those rules that govern these products. We see really interesting and exciting innovations with products, but the regulations aren't necessarily keeping up with some of those developments. In part, that's because of the business models that are used as well as the cost structures associated with them. And then, frankly, I think it's worth hitting it on the head. There's really significant disagreement, especially at the policy level, around what are basic consumer protections. And we're going to hear some of those issues discussed as well. So today you're going to hear from policymakers, consumer financial experts, as well as progressive industry representatives who are going to talk about really who are these customers, who are the underbanked, why are they turning to these products, what are the economics in offering these products to these consumers, and then we're going to have a policy panel where we're going to talk about what some of the implications are of this industry as it relates to the broader conversation around policy. So for those of you who are new to this topic, I hope it's going to be a useful primer. For those of you who've been thinking about it hard, I hope you're going to get some important insights and considerations that you'll be able to take away and ideally apply to what you're doing in this area. To begin our discussion, you're going to hear from Peggy Toohey, who is the Director of Consumer Protection at the U.S. Treasury Department. She's going to discuss the Obama administration's proposal for the Consumer Financial Protection Agency. After she gives her remarks, we're going to have approximately 10 minutes for questions and answers. We do ask, though, that you keep those questions on the CFPA proposal, and we ask that non-press take precedent in asking their questions, and then we will open it up to questions from the press. After Director Toohey's remarks in the Q&A, we're then going to hear from Roy Sosa. He is chairman of the socially focused Empower Ventures and founder and CEO of Empower Labs. He was also one of the co-creators of the NetSpend prepaid card. He's now running a socially focused venture capital fund, and he's going to talk about the economics of these products and of this industry. And then finally, I'm going to be joined in a policy discussion with Ed Merzwinski, who's with U.S. PIRG, and Bill Zavarillo, who's professional staff of the House Financial Services Committee in Chairman Frank's office. And as I said, we're going to talk about the policy issues with this area. For the sake of time, we have a really packed agenda, a lot of people who are going to be presenting. We have copies of everyone's biographies in the materials at the table, which hopefully you caught when you came in. And I just want to say thank you for joining us today. I think it's going to be a really interesting and useful discussion. Peggy?
Good morning, everyone. It's a pleasure to be here today to speak about the administration's proposal to establish a new consumer financial protection agency. Before moving to Treasury just a few months ago, I spent much of my career, as some of you know, I see some familiar faces in the audience, working to protect consumers of financial services at the Federal Trade Commission. In fact, I spent 17 years doing that. The consumer protection work at the Federal Trade Commission was heavily focused on bringing law enforcement actions and, whenever possible, trying to get monies back to consumers who were victims of predatory lending or other illegal practices. I now have the honor and the opportunity to work at the Treasury Department on financial regulatory reform, and I could tell you that based on my background at the FTC and trying to do that work for consumers all those years, I think it is clear that we need a complete overhaul of our approach to protecting consumers in the financial services industry. Today's consumer protection regime just experienced a massive failure. It could not stem the plague of abusive and unaffordable mortgages and abusive credit card practices, despite clear warning signs. It cost millions of responsible consumers their homes, their savings, and their dignity. And it contributed to the near collapse of our financial system. We did not just have a financial crisis, we had a consumer crisis. And as you know, Americans are still paying the price, and those forced into foreclosure and bankruptcy will pay for years. As part of its proposal to reform the financial regulatory system, the administration has proposed creating a new agency with just one job, looking out for consumers across the financial services landscape. Today, the current approach to consumer protection fragments responsibilities among 7 different regulators at the federal level. All of the federal banking regulators have higher priorities than protecting consumers. The current system invites regulatory arbitrage. Banks can choose the least restrictive supervisor among those several different banking agencies. And non-bank providers of financial services escape federal supervision almost entirely. For non-bank providers, there's no federal consumer compliance program in place to ensure that on an ongoing basis, not just after the fact law enforcement, that they are complying with the law. And I believe this lack of ongoing federal oversight of the non-bank consumer financial services sector is a particular problem for consumers who rely on the non-traditional shadow banking system that is the subject of this event today. This part of the consumer financial system has indeed been in the shadows and on the margins of our financial regulatory system at the federal level. And as Melissa mentioned, at the state level, there is some oversight and regulation, but it's quite uneven and inconsistent, and I think in terms of overall protecting consumers nationwide, inadequate. The result is a system that has led to ineffective regulation, inertia, and uneven standards. For example, it took the federal banking agencies until June 2007 to reach consensus on supervision guidance to impose even general standards on the sale and underwriting of subprime mortgages, 2 years after evidence of declining underwriting standards emerged in the regulator's public survey of loan officers. It took additional time for the states to adopt parallel guidance for independent mortgage companies, and it took yet another year for the federal agencies to settle on simple model disclosures for subprime mortgages. By that time, we were deep in the throes of financial crisis precipitated by subprime lending. Given this failure, the administration's proposal calls for a complete overhaul of the current structure. It calls for the creation of a new agency that will have mission focus, market-wide coverage, and consolidated authority. And we believe each of these elements is critical in creating a successful consumer protection agency at the federal level. First, the Consumer Financial Protection Agency's sole mission will be to protect consumers. In the current system, at the federal banking agencies, consumer protection competes with their primary mission of ensuring safety and soundness of the banking institutions. Ensuring that banks act transparently and fairly with consumers is simply not their highest priority. Second, We need a consumer protection agency that will have jurisdiction over the entire marketplace of consumer financial products and services, non-bank and bank financial service providers alike, including mortgage brokers, mortgage companies, finance companies, payday lenders, check cashers, the whole range. We need one agency that can ensure the same oversight, for example, for mortgage lending, no matter whether it's a large independent mortgage company, a large non-bank subsidiary of a bank holding company, or a large bank lender. This will create a level playing field for all providers, regardless of their charter or corporate form, and will ensure consumers get the same protection no matter what type of entity they're dealing with. Under our current system, we have two different and uncoordinated regimes, with banks subject to extensive regular examinations and regular compliance oversight, such as it is, and non-bank providers offering the same financial services products to consumers not subject to any regular oversight, again, except for the after-effect law enforcement that can be done by the FTC. And that unlevel playing field has had serious consequences. In the years leading up to the crisis, capital flowed heavily to the non-banks, in part because they had the advantage of weak oversight. Banks with straightforward credit products, like many community banks, were forced to compete with the less scrupulous part of the marketplace outside of the banking system. This lack of oversight brought down standards for everyone across the board. So we need an agency that can ensure high and uniform standards across the entire marketplace. But we need an agency with comprehensive market-wide authority, not just to level the playing field, but because the banking and non-banking worlds of consumer finance are interconnected. For example, credit card portfolios are sold to non-bank debt buyers, yet no single regulator is able to address the problems that can exist when the data in these portfolios is not sufficiently accurate or complete to ensure that debt collectors down the road collect the right amounts from the right consumers and can verify the debt. As another example, there are non-bank marketers that develop credit card programs for bank partners, including all the marketing activity up front and all the collection activities at the back end. In my experience at the FTC, the Federal Trade Commission and the FDIC both had to pursue parallel actions against a non-bank company called CompuCredit, which worked through banks to market and deceptively market, in the FTC's view, high-fee, low-limit credit cards to consumers because it tried to argue that neither agency had jurisdiction to challenge its practices. Well, we did proceed in parallel fashion, but we really need one regulator that can go after both types of entities without question. We have an interconnected consumer financial services system, and so we need comprehensive jurisdiction. Finally, we need an agency that has consolidated authority, consolidated rulemaking, supervision, and enforcement authority. Under today's system, the authority to write rules is split up among a number of different agencies, and that authority is largely divorced from the enforcement and supervision. For example, the Federal Reserve Board has rulemaking authority under the Truth in Lending Act, but HUD has rulemaking authority under the Real Estate Settlement and Procedures Act. The result is two different forms that cover different aspects of the same mortgage loan transaction and use different language to describe some of the same aspects. This authority needs to be combined under one agency so these forms can be harmonized and simplified and integrated into one understandable mortgage disclosure. As another example, the Federal Trade Commission was recently given authority to write rules with respect to mortgage loans, but this authority can only apply to the non-bank mortgage sector. The Federal Reserve Board, on the other hand, has the authority under the Home Ownership and Equity Protection Act to write rules regarding mortgage loans for the whole marketplace. Under the Fair and Accurate Transactions Act, 6 federal agencies were given some authority to write coordinated or joint rules under various provisions for the Fair Credit Reporting Act. It took the agencies almost 6 years to publish rules for the accuracy and information reported by furnishers to credit bureaus. It's important to consolidate this rulemaking authority so that rules can be harmonized and updated expeditiously by one agency that also has a deep understanding of the marketplace. It's important that the agency that write the rules also supervise the entire marketplace so that it has the information it needs to write balanced and timely regulations. This marketplace coverage will ensure that consumer issues with all the various products and similar products can be looked at consistently. For example, the agency could establish disclosure requirements that are consistent no matter whether the short-term loans comes from a payday lender or from an overdraft protection plan. And it will be able to provide the oversight and federal protection for consumers who have no choice but to deal with check cashers and other alternative financial service providers. As President Obama said in his speech on Wall Street on Monday, the Consumer Financial Protection Agency will have the power to make certain that consumers get information that is clear and concise and to prevent the worst kind of abuses. Consumers shouldn't have to worry about loan contracts designed to be unintelligible, hidden fees attached to their mortgage, and financial penalties, whether through a credit card or a debit card, that appear without warning on their statements. In short, the new agency will bring higher and more consistent standards, stronger and faster responses to problems, an end to regulatory arbitrage, a more level playing field for all providers, and more efficient regulation. A Consumer Financial Protection Agency will restore, I believe, the trust and confidence on which our financial system so critically depends. I want to thank you for giving me the opportunity to talk about this morning, and I'll take questions.
And as I said, if there are questions from non-press, let's have those first. And when you do get up to ask your questions, if you can introduce yourself and let us know where you're coming from. And do we have a microphone? Would you mind speaking loudly for us?
Sure. John Ryan with the Conference of State Bank Supervisors. And Peggy, first, we appreciate the administration's proposal and an effort by the administration toward more of a partnership rather than an obstacle to consumer protection. One of the concerns that we have, and this isn't in the current proposal, but as this debate gets simplified into the sort of bank, non-bank discussion, it oversimplifies. And in our experience, that actually the products that we've been talking about in the mortgage arena were offered as much by the bank universe, meaning the bank affiliates and subsidiaries, and they were no more regulated than the non-banks. And my concern is, and when the preemption occurred around the subsidiary, and given the presence of those institutions in states, it became much more difficult for the states to legislate for the rest of the universe. So how can you subject 50% to these restrictions when others aren't? And I know that's a little backwards from what Washington thinks, that all the stronger standards were at the federal level. But what I'm concerned about is Congress seems to be leaning towards maybe moving the banks out of, again, establishing preemption for the bank universe and a separate regulatory structure for the bank universe, and then having the floor not ceiling apply to the non-bank universe, and we're right back where we started again. So any thoughts on that?
Well, as I mentioned in my remarks, we think it's critical that it be one system with one regime, and the administration has supported, and part of the legislative proposal is that the federal rules would be a floor, not a ceiling, including for banks. And so that is part of the proposal. That is part of what we think is necessary to have uniform protections for all consumers and a level playing field for all kinds of providers.
Thanks, Peggy. And we definitely want to keep this 2 questions about the CFPA. So thank you, John. In the back.
Hi, I'm Jen Newell from CFPB, and I'm wondering if any kinds of insurance products are under consideration for regulation and oversight?
That was our any kind of insurance products under consideration for oversight.
For the most part, this proposal would not cover insurance products except for credit insurance products, title insurance products, and mortgage insurance products.
Question in the front.
I'm Kara Camacho with Congressman Stephen Lynch's office, and you talked about how community banks had their level, they had to meet unscrupulous methods of consumer banking. Could you give examples or talk a little bit more about that?
Yes, I think the point is that without sort of base standards that apply to those that have to compete, the banks that have to compete with the non-bank sector, and I acknowledge and understand what John's saying, that it's not that we're saying there was perfect oversight. In fact, there was not of the banking sector for different reasons. That what we think we had was basically a race to the bottom. We had non-bank lenders, at least in the first instance, that were offering the exploding arms and the payment option arms. We had aggressive mortgage brokers out there trying to push the products on consumers that would be the best for them and not necessarily the consumers. And so that and the non-bank lenders that were following suit and pushing those products and often steering consumers into either unacceptable loans or loans that were higher priced than they could really qualify for, because that's where the market incentives were. And so the situation was that the banks had to compete with that. And so, say a small community bank that wanted to stick with the tried and true may have felt pressure to offer those products also. And so we think that that's a problem, that we need basic standards that protect all consumers, and we think that will help the responsible players out there, like community banks, who want to offer straightforward, transparent products for consumers.
Question in the back.
Hi, my name is Jeff Seidelman. I'm not affiliated with, I work for a private sector firm, but I'm not, the question's not coming from that angle. I happen to counsel homeowners in a local geography who are going through foreclosure, and I'm struck by the fact that many of them were purchased products when much better products were available for them. The disclosures that are made are typically made at settlement. People oftentimes don't read them. They're often not in their native language or in a language that they understand. And they trusted the person across from the table, so they said, "Trust me, this is okay." It strikes me that the sort of disclosure that's done in the credit card industry on the marketing, when a product is marketed, would be a much better approach to this than disclosure on settlement. And I was wondering what your thoughts were on that.
I think my thoughts on that, and basically the structural kinds of changes we're talking about in terms of the Consumer Protection Financial Agency, don't get into particular policy recommendations on that specifically, but I will say that I think the structural changes we're talking about will enable us to have an agency that will be on top of those issues and recognize exactly what you're talking about and be able to change the system more effectively and more quickly because of its comprehensive view and of the whole marketplace and understanding of what's going on for consumers, of exactly the nature you're talking about, and its ability to then have the authority to do something about that.
Question up here in the front.
Thank you. My name is Susie Sosa. I'm with Empower Ventures. And obviously, I understand very clearly the need to provide a level playing field and a sort of basic level of protection for all consumers. But there's also the danger that in creating new regulations that you might inadvertently push out of the market products that people actually need. And there's sort of this gray space between providing a common level of welfare and becoming paternalistic and telling people what they do or don't need. And I was wondering, what are the criteria that help you determine what is the right level of regulation and protection without making choices for people?
Right. I think that's an excellent question, and I think there's specific provisions in the proposed legislation that would require the agency to consider the costs and the benefits and the effect on access to financial products and services when it considers its regulations. So I think that's one requirement in terms of what its regulatory responsibilities will be. I think in terms of a specific legal matter. I think the bigger picture, though, is that that we think that with basic standards that innovation can thrive. It can be the right innovation, not the kind of innovation that we've seen in the past that led to exploding arms and hidden terms, and that was basically kind of hide the ball type competition. So we think that actually with some basic standards, there'll be trust restored and the ability to compete fairly and transparently such that good innovation will actually thrive. In terms of the balance, that's why we think it's so important for this new agency to cover the entire marketplace so that it knows the entire marketplace and knows what the issues are for consumers across the spectrum, and it knows what the issues are for the industries across the spectrum, banks and non-banks, and knows it well, has a deep understanding so that it can make the right call, so it can balance that effectively.
Question in the front.
Hi, I'm Gretchen Lehman, and I'm at the Department of Health and Human Services. And I'm going to ask what I'm hoping is a very simple question. Not coming from a financial institutions or regulatory background, my understanding of this essential problem has been that the regulations were based on particular institutions as opposed to product-based regulation. And so what I'm wondering is, at the end of the day, what is being proposed, is this going to be talking about products regardless of who is offering it in order to cover the entire marketplace, and saying if anyone is offering some kind of product that is allowing you to, borrow money to buy a house, even if they don't call it a mortgage, whatever they call it, whatever fancy terms they come up with, is the regulation going to be based on those products and services as opposed to how this organization was incorporated, what name it was given, where it was falling within the institutional world?
I think that's exactly right. That's the concept behind the basic structural change that's being proposed. We have some regulation now that's product-based. For example, the Federal Reserve does, as I mentioned, regulate under the Truth in Lending Act the entire marketplace for mortgage products, but they don't supervise. They don't have the jurisdiction to know what's going on out there in the non-bank world, and so they don't have the benefit of, say, the information we had at the FTC to know what might be needed to update those rules and to address the problems they're developing, especially when they need to be addressed, not years after the fact. And so that's exactly what part of the concept is that this will be breaking down those barriers between exactly what type of institution is issuing the loan. Is it a state member bank of the Federal Reserve System, or just, is it a national bank? Is it a federal thrift? Is it a non-bank provider? Right now, it's terribly balkanized, and that's exactly what we're approaching, is to break down those barriers and to make sure one agency with one mission can cover the whole marketplace and have the authority to make it all make sense and adequately protect consumers.
I don't think this is unique to this area, but and I don't know that there's really an answer to this, but I'm wondering, particularly like in the credit card context, when Congress passes new legislation or an agency promulgates new regulations that for probably good reasons don't go into effect for a while, and the companies use that period of time to enact lots of practices that they'll be forbidden from doing in the future that harm consumers. Is there really any way to try and prevent that from happening?
I'm not sure there's a way to completely prevent that. There's always, no matter what, just the nature of lawmaking and rulemaking are such that laws are passed and there's some time to comply. But I do think that the kind of ongoing, with one agency with ongoing oversight and the knowledge of what's going on, can act more quickly to put that rule into place in the first instance, and so that any needed lag time or any problematic lag time could be shortened.
Hi, my name's Hillary Muglu. I'm with Partners for the Common Good, which is a certified community development financial institution. So as a quick follow-up question to what this lady behind me asked about if what you just talked about, product oversight, would affect institutions that are already certified under the CDFI fund arm of Treasury?
I'm not sure about that. I'd have to check with the folks that know that area better than I and answer your question. So if you want to give me your card later, I can try to get back to you on that.
Which products do you have in mind when you ask that question?
Well, we actually are not a loan fund, so I'm speaking sort of in terms of the broad arena of banks and credit unions that are depository that offer products similar to the traditional mainstream banking system, that are already mission-based and consumer protective. And so I'm wondering if there's a connection between CDFI fund and this office and what that connection is.
There's
So
nothing that I
mortgages,
know
you
of
know, all of
specific
it.
in the legislation. And so I would think the products that are offered there needs to be legal compliance with whoever's
Right.
offering them. And to the extent there's fewer issues for various reasons, then that might mean certain rules don't, or certain issues aren't there. But I'll just have to get back to you on that.
Okay.
Great, thank you. We can take one more question. And we're just about out of time.
Hi, my name is Cheryl Buford. I am a little confused. I'm wondering if, when you say that you're consolidating the regulation, does that mean that the Federal Trade Commission or FDIC will no longer have consumer protection as a part of their responsibility? Are you taking that over, or will there be continue to be parallel protections from a variety of agencies?
The idea is to mostly consolidate the authority under this new agency. With respect to the Federal Trade Commission, for example, the authority for enforcement of the particular consumer credit statutes that they have responsibility for the non-bank sector, like the Equal Credit Opportunity Act, the Fair Debt Collection Practices Act, the Fair Credit Reporting Act, would move so that this new agency would have primary enforcement authority. With respect to financial fraud, the administration's proposal calls for the FTC in the financial services marketplace, so things like debt settlement scams and foreclosure rescue or loan modification scams, telemarketing scams. The administration's proposal calls for the ability of the FTC to continue its work under the Federal Trade Commission Act. That part of it doesn't change, and so that it can continue that work in a parallel fashion expeditiously. And the rationale for that is that with the fraud end of the marketplace, we need the more cops on the beat, the better. With respect to statutory work, the primary enforcement would move to the new agency.
Great. Thank you, Peggy. We really appreciate your joining us today. Okay, we're going to move into the next panel, or to the first panel, which is going to be moderated. If you all want to come on up and bring your name tags, please. This panel is going to be moderated, and it's a Q&A format, but moderated by Rachel Schneider, who is the Innovation Director for the Center for Financial Services Innovation, a nonprofit affiliate of Shore Bank, which is focused on the underbanked consumer and illustrating ways for the industry broadly to serve this population well. So thank you, Rachel. Come on up.
Hello, everyone. Good morning. So the goal of this panel is really to understand more deeply the underserved consumer in terms of what their needs are and demands from financial services. And we're going to do that mostly from hearing from these four gentlemen to my right, all of whom are innovators in the space of serving the underserved. I'll start by giving a little bit of background. My organization, CFSI, has done a national study of underbanked consumers. We did it in March of 2008. And essentially, we surveyed almost 3,000 consumers about their financial behaviors and attitudes. And the goal of that work was really to understand what kinds of behaviors drive and what kind of attitudes drive the use of banks versus non-banks, payday lenders versus prepaid card issuers, in order to really understand what product features people want and need, and understand more about who the underbanked population is. And what we learned was that 40 million U.S. households are financially underserved. So this is a huge marketplace. In that group, it's roughly 50-50 split between entirely unbanked people who have no bank account of any kind, whether checking and savings, versus people who do have a checking or savings account, but also rely on a regular basis on other kinds of non-traditional financial services providers. This group has fairly meaningful buying power and spends a great deal of money every year on financial services. Our estimate is that there's probably a $25 billion spend per year by underserved people on financial services. And the income range varies quite a bit, with a median of $26,000 and a mean of $47,000. So this is a group that is making conscious choices to use non-bank services, but is in fact accessing financial services quite regularly. We asked how many transactions are you conducting per week, for example, or per month, and found that underbanked people, some portions of the underbanked universe, are making as many as 10 transactions a month. Some are making none, or one or two. So it's a very wide range of behaviors that are reflected. And part of the goal of our work was to try and identify different segments within the underbanked population so that we can understand what products are needed for different segments within it. So, for example, we determined that one of the largest segments within underbanked is a group that we're calling Next Wave, who is young, largely minority, 25%, Spanish-speaking, really reliant on cash, versus another large subsegment of the group, which is older, more likely to be white, making many transactions every month at both banks and non-banks. So it's important, I think, to come to this work with an understanding of how diverse and extensive the underserved population is. And as a result, there's a wide range of kinds of products and services that this group needs. So we have today the opportunity to hear about this same issue, understand better who these consumers are from some of the folks who are providing these kinds of services. And I think we'll go in order here, if that works for all of you. I'm going to move. You're going to move. John's going to move over there. And the format and so each of our panelists will have an opportunity to introduce themselves and the work that they do, say a little bit about the consumer that they're serving, and then I'll ask some questions, and then we'll open it up to all of you to ask more questions. So John is one of the founders and leaders of Advent Financial Services. And prior to being at Advent, he was a leader at H&R Block, where he led several different, I'm flipping to your bio quickly, but led multiple teams who developed a variety of interesting products for the underbanked. And he'll tell you more about Advent and consumers.
Thanks, Rachel. Morning, everyone. Our company is based in Kansas City. We offer low-cost permanent banking accounts to consumers at tax time, as well as offering to the tax preparation industry a dramatically lower cost set of products and services related to the settlement of tax refunds for consumers that so far and for a number of years has not been available to this industry. My role in the panel today is to talk about refund anticipation lending, tax time lending that we'll discuss a bit briefly, and the consumers that use those services, though, as Rachel mentioned, I've worked on a number of things related both to savings, banking, payments, and other services delivered at tax time. So I might briefly explain what these products are and then talk a bit about the consumers that use them. So principally, consumers are choosing to receive their tax refunds from the IRS and state government either by paper check that is mailed in a number of weeks to their home, or by direct deposit to a bank account that they may or may not have. The industry has responded to that by creating principally two categories of products. First is a category of product called the refund anticipation loan, which is a loan extended on all or a portion of a consumer's tax refund, typically $2,500 to $3,000, usually fueled by EITC and or other refundable tax credits. A small group of banks, 6 or 7 banks across the country, are the principal providers of these products to the industry. And the way that it works is the bank sets up a temporary bank account for the consumer. For the deposit of their tax refund, they extend a loan against that refund in approximately 8 to 15 days. A deposit comes from the IRS. The consumer's refund loan is repaid. Their tax preparation fees are paid to the consumer, and any net is provided to the consumer. This product in a traditional delivery model is $100 to $120 or more. A second category of product is called by a couple of different names, but I'll use refund anticipation check. This is in which a bank sets up, again, a temporary bank account for a consumer to receive their tax refund by direct deposit in 8 to 15 days. Their tax preparation fees are netted from their refund, paid to their tax preparer, and the remaining proceeds are provided to the client, typically in the form of a cashier's check, as is the principal distribution method of a refund anticipation loan. So in the first quarter of any calendar year, there are billions of dollars of checks flowing into the hands of low-income families. Those are principally going to check cashers for cashing, and the typical rate exceeds 2 3/4 to 3% of the face value of that check. It's a very high-cost transaction for the consumer when you consider both tax preparation, the cost of a settlement product, and the cost of converting that settlement product into usable currency. A bit of information about the consumers who use these products. Obviously, there's a lot of different segments who consume these products, lots of generalizations that can be taken, but I'll try to give you a few things to work with. The typical consumer would have approximately $20,000 to $25,000 of household income, predominantly unbanked. When I say predominantly, I mean around 60%, unbanked or underbanked. So they are used by fully banked consumers for other reasons. Typically, users of these products are repeat users. They use them every year. And typically, they are heavy users of other alternative financial services products, check cashing, payday lending, title lending, and others. There has been really limited innovation in this industry over the last couple of decades. The preservation of the status quo has been important to the profitability that's associated with it. To give you a flavor of just a bit of what we have been trying to do, consider that when I talked about those products, in each case, a bank account is opened for the consumer. That's 25, 30, 35 million bank accounts that are opened and closed for unbanked Americans in about a 6-week period. It's a real opportunity. What we have built is a very low-cost bank account that's permanent, even if the client chooses to use it only for their tax refund and use it again the next year. It's available to them, and a version of that lending product that costs about $20 instead of $120. So we think this kind of innovation may have a place in the tax preparation industry as well as with the consumers who use them. Just a couple of brief points and then I'll wrap up. Why are consumers using these products? I think it's immediate access to money, to liquidity, which is important, both for perhaps practical needs, but also for the notion of predictability and closure. So the desire to actually finish this transaction and know what's going to happen, as opposed to wait an unknown number of weeks for a check to arrive into a location that may or may not be secure. It allows the consumer not to pay up front for their tax preparation. And also it's just part of the industry methodology in an industry that has marketed heavily as well. And I'll leave you with this. Think about tax time as a really important time and a really interesting opportunity for financial services delivery and the regulation that covers it. Because consumers are thinking about money. They have their documentation available to them, their financial documentation available together, and are ready to use it. They're typically working with someone who is paid to provide them service. And perhaps most importantly, they have money. In some cases, a quarter of their net income that may be coming in one lump sum. And so we really think it's a unique opportunity to change the game for consumers and the businesses that serve them. Thanks.
So we'll take questions, as I said, at the end of our 4 panels having spoken. So let's move on to James Gutierrez. James is a serial entrepreneur who is committed to helping 50 to 60 million underbanked people in America. See, now I've turned to the bios, so I can be a little bit more articulate. In 2005, he co-founded Progreso Financiero, an innovative and socially responsible financial services company that offers unsecured loans ranging from $250 to $2,500 to Hispanic families that lack established credit scores and banking relationships. So, James.
Great. Well, thank you. Just quick show of hands. How many of you have been to Astoria, Queens, or Boyle Heights, East LA, Huntington Park? Just kind of raise your hands. Okay. How many of you have? How many banks have you seen in those communities? And then last question: 5 p.m. on a Friday. How many of you where have you seen the lines? Are they outside the banks, or are they outside the liquor stores and check cashers? So this is the reality that we're dealing with. It's nice to, I think it's nice to consider that the banking world is going to solve our problems, but unfortunately, Jose and Maria are, fortunately, Jose and Maria are customers, but unfortunately, they don't have access to a lot of banking products. So, tell you the story of Progreso, I have to tell you the story of Jose and Maria. Jose and Maria work hard in this country. They want to get ahead. They care about their children's future. They want the American dream. They want a better life. They work hard day and night, but unfortunately, the financial system may actually get in their way of achieving their lifelong aspirations. The problem that we're addressing is that every time Jose and Maria, they want to communicate a lot, especially in the Latino communities, a lot of communication going on, talking on the phone. They apply for a cell phone contract, and they ask them to run their credit check. Comes back, says, sorry, we can't give you a cell phone contract because you don't have a credit score. They go to apply for rent, to get an apartment, a lease. Sorry, you don't have credit history. We can't approve you for that. Some cases try to apply for a job. Sorry, you don't have credit history. Can't approve you for that. So very quickly, Jose and Maria learn it's important to have buen crédito in this country, right? Good credit is sort of the key to your future. And the way we look at it is, not having a credit score in the U.S. is kind of like not having a face. It's like not having an identity. And we think somebody needs to solve that problem. And so Jose and Maria, they'll get paid in a paycheck, and they'll take that to a check casher because it's faster to get the money than giving it to a bank who will hold it for 3 days, and they need the liquidity, to live paycheck to paycheck. What we wanted to do is say, how do you empower Jose and Maria so that they're really building a better future and they're moving up the financial ladder? And we felt that you got to give them a credit score because, one day if they want to build empowerment and wealth, they're either going to start a business, small micro business, and in which case they need a small business loan, and to do that they need a credit score because a bank will only make that decision if you have a FICO score and a good one. Or you buy a home at some point, and same process there. You need to fill out an application. You have a credit score. So without a credit score, you really don't have a ticket to a better life, to the American dream. And so what Progreso started doing is we said, and now that we've learned from our data, about 60% of our applications, let's say we processed under 100,000 applications. We're only in California. We do everything in Spanish. We have loan documentation, loan documents in Spanish. And we serve people in booths that we have inside Hispanic supermarkets. So we've probably all heard of the Krogers and so forth. But in all these communities I mentioned, they're called Mi Pueblo, they're called Cardenas supermarkets. And those are the guys that actually kind of serve our customers. So we set up booths inside those stores to provide responsible small loans. And what we found is that most of the people, about 60% of the applications came from people who didn't even have a FICO score, right? So how is a bank going to score someone that doesn't even have a credit score, right? They just decline you. That's what they do. And so there's no way in, and there's no way to build a score. And so what we did is we built a lot of tools and risk models. We felt, look, this is a problem that the credit card industry has solved. Unfortunately, now they all reside on the data that exists in the 3 major credit bureaus. We could build some similar scoring and some technology there to solve this problem. And so now, fast forward, we've made about 25,000 loans since we started. Our goal is to make 1 million loans and serve 1 million people in the next 3 years. We want to lend out $1 billion of capital in small, tiny increments and give a lot of people access to the opportunity to build a credit score. The average, Jose Maria who comes to us starts with no score, and after 2 to 3 loans, they have about a 640 FICO score, and they're on the map. And so that's our mission. That's what we do, and I'd be happy to talk to you more about it. But our average loan is about $900. It's a 9 to 10 month loan. It's an installment loan, so it's not a revolving relationship. It's little tiny fixed payments. In Spanish, we call them pago fácil. It's a little small pagos of payments, easy payments. Excuse me. We do so much marketing in Spanish. Sometimes I forget. So $60 every 2 weeks. It's very easy to understand. In Mexico and in Brazil and in Argentina, Central America, that's how you shop. You buy things in little payments, and so people are used to that. So we brought that. We actually brought a lot of concepts from Latin America, imported them. Probably one of the first examples. of innovation of importing from Latin America to the U.S. and then using that to go after this population in a different way. And we think it's a very bright future, but unfortunately, it's not so bright for our customers because with the Credit Card Act, with kind of banks having more and more losses, credit is significantly getting pulled back, and everybody's relegated to the only option they have, besides Progresso, which is a payday loan. We think you could do better than that. So,
Thanks, James. So our next speaker is Patrick Brown. Patrick is the Executive Vice President of Emerging Markets for NetSpend Corporation. And in that role, he's responsible for the development and implementation of business strategy and overall growth of NetSpend as it relates to new products and to the Hispanic market.
Thank you. James, great segue there. My last name doesn't allude to it, but I actually grew up in Latin America, came back to the U.S. Mother's Hispanic, so I spent many years down there. And really the concept of prepaid and unbanked is the common concept throughout Latin America, whereas here it's a novelty. I often ask the question, what service can you think of, a product that you can think of on a day-to-day basis that you and I use here in the U.S. that is prepaid? Can anybody think of something that they use in financial services sector that is prepaid on a regular basis? The only thing, what's that? The Metro card.
Yeah,
Perfect.
that's
So the Metro card, right? Novelty, something new, but insurance, right? Generally you pay insurance in advance for the opportunity or the privilege to be covered for 6 months. That's the concept of prepaid. Well, in the rest of the world, or in Latin America specifically, or more so, prepaid is very common, whether it's a cell phone, whether it's your financial services, whether it's purchasing an automobile or a home loan or whatever it is. If you don't have a significant amount of money to put down or to pay for the full amount, you're not getting the product. Another example, prepaid top-up in the United States is very new, relatively new, but in Latin America and Mexico specifically, over 90% of cell phones are prepaid cell phone plans. So it's a difficult concept for people to understand here, but it's very common throughout the world. NetSpend is focused on prepaid debit specifically. Prepaid debit really has kind of 4 legs to it, just very broad categories, if I may. Payroll is one type of category or card where a consumer would obtain a prepaid debit card or a payroll card from their employer. That's one way of getting a card into an unbanked or underbanked consumer's hands. Gift cards and rebates, which I think somebody was alluding to earlier, is probably something that many of you are accustomed to or have used, but those are prepaid cards. Healthcare industry is using prepaid with flexible spending accounts, which you may have or may not have. And then the area that we're biggest in, which is general purpose reloadable cards. So NetSpend's the leading provider of general purpose reloadable cards, prepaid debit cards in the U.S. We have a big group as well in the payroll industry. And really our focus is providing convenience, security, financial products to the underbanked market on their terms in their locations. James was alluding to it earlier. The bank is not open after 5 p.m. or 6 p.m. on Friday. The bank is not open maybe till noon on Saturday, but not in the afternoon. Is not open on Sunday. So we allow individuals to do banking transactions, really deposit transactions onto their prepaid cards in our retail locations throughout the country. So we extend really a banked product because at the end of the day, we may call it prepaid debit, but in the purest sense of the word, if you don't have money in your checking account and on your debit card, you can't use it either unless you have overdraft tied to it, right? Or a line of credit tied to it. So the product that you use in your wallet today is really not that much different. We just make it more accessible to the consumer in different retail locations than a traditional bank branch. I love to tell the story, and our CEO tells it a lot better because he's the one that experienced it, but Dan Henry, our CEO, he came on board probably about, I guess it was January, February of 2008. He was maybe 30 days on the job, on a flight, gets into the city that he's going to for a meeting, gets in a cab, and the gets on a cell phone conference call, starts talking away, hangs up the phone, and the cell phone driver, the cab driver turns around and says, "Are you with NetSpend?" And Dan starts getting a little bit nervous, and 30 days on the job, wasn't sure what was getting ready to happen, and said, "Yes, I'm with NetSpend." And the cab driver starts, pulling into his wallet and pulls out his card and says, "I'm a NetSpend customer. I love you guys. This is the best product since sliced bread. I used to be with a bank. I've been with you guys for over 5 years. Honest, true story." First truly unscripted interaction with a consumer who uses our product. And the consumer's name, the gentleman's name was Isaac. I won't use his last name for privacy reasons, but Isaac loved the product. And Isaac is a perfect example of the consumer, of the millions of consumers who use our product today. An individual who is unbanked, cannot get a bank account. His family members don't want a bank account because he was pushed away from banks. High school educated only, as probably approximately 63% of our customers are. Less than $50,000 a year in income, as over 70% of our consumers are. Average balance on the card is about $100, as the majority of our consumers are. Average ticket size or purchase amount is about $28, $38, as most of our consumers. Average load amount, or the amount of money that they deposit on the card, is about $200 at a retail location, or $500 if it's a direct deposit. So Isaac is a perfect example of the consumer that we serve, that banks traditionally have not wanted to serve or can't do in an efficient way because of high costs that they may have tied to their model. And that's the consumer that we passionately serve. We serve on a daily basis, and we try to continually do the right thing for those consumers, for them to stay with us over the long term.
Thanks very much. Our next speaker is Manuel Orozco from the Inter-American Dialogue. Manuel is the Director of Remittances and Development there, and he's conducted extensive research, policy analysis, and advocacy on issues relating to the global flows of remittances and migration and development worldwide. Manuel.
Thank you, and good morning. And I don't have much products to sell you, but I'll try to sell some ideas. I passed around a table. I don't know if you have it. Let me start with the following. I was asked to talk about remittances, and I think the point of departure when talking about remittances is basically the individual that sends the money. This is a foreign currency cross-border payment that is sent predominantly, more or less 85% of the total volumes by foreign-born people, by immigrants predominantly. The remaining 15% is Native Americans and small businesses. Many businesses use the foreign currency cross-border payment mechanism, aside from SWIFT, as a way to settle trade transactions internationally. Now, this population, basically, we're talking about 12%, 13% of the U.S. population, 40 million people, who use more or less 6 different kinds of financial services. And you heard some of the services that the colleagues mentioned before, but the most used, for the most part, by migrants is sending money. 70% of immigrants remit to their home countries, against 20% of migrants who use a money order, or 40% who use check cashing, for example. The type of financial services that they demand, predominantly in the field of money transfers, is used for the most part through what we call money transfer operators, that is, companies like Western Union. Increasingly, the banking industry has penetrated into this market as a remittance service provider, and their participation in the market has grown, I think, considerably, from less than 1% in 2004, when we started doing surveys about the method of sending, to about 5% in 2009. It's an increasing percentage that is being observed predominantly among different sectors of the population, of the migrant population. Some people are using the internet to send money. Others are using just debit cards in the most primitive way, but are increasingly relying on that. The customer itself, it's a mixed bag of different things. On the one hand, is what you can call unbanked or underbanked individual with an income that, as Rachel mentioned, of about $27,000 a year, who remits basically $4,000, or 15% of their income goes to take care of their families. But this is the interesting issue. They might be underbanked or unbanked. However, it's a population that, aside from sending money and doing other type of financial services like bill payment, money order, check cashing, etc., they also have one of the highest stock of savings than the average population. The average amount of savings that they have is about $4,000. Even during the time of the recession, they have been using their savings to rely on mechanisms to mitigate the current recession. The unemployment rate of immigrants is about 12% right now. Unfortunately, there are a number of challenges. They may have liquid cash in their pockets, but not at a financial institution. They do not have fixed assets. If they own a car, it's a used car worth $3,000 against the average $15,000 car in the United States. So you see a mixed bag of individuals who are underbanked but yet valuable from the financial standpoint. So it's a very interesting group. So if you look at the type of transactions that they perform, just in terms of remittances, the estimated volume of outbound transfers from the United States to the rest of the world, 60% that goes to Latin America, it's over $100 billion in money transfers. And the revenue base of this is nearly 10%. It's about 6%. Take a little bit if you include or exclude Western Union. But it's a profitable business from many respects, yet it's still a business that it poses one fundamental challenge that I think it is, that is that for the most part, the user of remittances is an individual that the financial establishment that uses to send money is one in which only performs two different kinds of financial services, either sends money or cash checks, or sends money and buy a money order. But the total gamut of financial services that they use, they really don't adopt it in the same financial institution. Integrating those services in one place is actually one of the challenges and one of the important strategies. The other one is cost. There is still a problem of paying prices that are above their capacity sometimes, and sometimes that they are basically the result of speculation in the market. Another challenge is basically predominantly a lack of financial access into the system. And in that, I think there are a number of solutions that one can provide: increased competition, increased financial literacy and advising to this population, establish partnerships with a range of financial institutions, banks, financial service centers, among others, grassroots associations, in order to develop mechanisms to integrate people into the financial system. And fourth, show and make a better case of the profitability of the business. If you're looking at a population that is saving $4,000 for basically over 25 million of people, but this is predominantly informally saved, you're basically having billions of dollars that are not put to work. And the majority of these billions of dollars are actually sitting down in the most marginalized sectors of the U.S. society. So these are challenges that need to be addressed. And then there is another challenge that I think cannot be ignored, which is immigration policy. There is basically, it's not. I'm not editorializing, and I'm finishing here. but you know, we have the hypocritical approach of talking about financial services to the underserved, but we don't talk about providing financial services to poor immigrants, who some of them might be legal or illegal, but they also need to be part of the equation, especially if there is a demand for their labor in the United States. And politically correctly speaking, many people just disaggregate the two. And I think it's a political risk, but it's a risk that needs to be taken just as much as you want to take the risk of making money out of them. Thank you.
So I'll start us off with some questions, and Manuel, let's start with some questions for you. I love the information that you've passed around, and one thing that you pointed out is the extent to which the savings behavior is really happening outside of formal savings institutions. So can you say a little bit more about how this community is saving and what that means? What does informal savings look like?
Well, it looks like everybody else. We all keep cash with ourselves. Whether you keep it, I keep it in my briefcase. I won't tell you how much I carry in cash with me, but I carry, more than $100. And immigrants, basically, I'm not going to reveal how they do it, but you carry some amount of your money in with yourself, and I'm talking about $500 to $1,000 on a regular daily basis. Another one is you leave some money hidden somewhere in your house, and the other one is that you either give it to other people to take care of it. Sometimes they put it in a bank account of somebody else's, which is a huge risk, but many people, we've been doing financial advice more than literacy to immigrants across the U.S. and in other countries, in Spain and Russia. And the one thing that we realize is that when you start talking to people about financial issues, budgeting especially, the question they ask is, well, where do I go to put my money? And there is a lack of understanding and knowledge that there are financial institutions where you can put it. So it's something that is missing in the whole map of financial service provision.
Mm-hmm. And so I know you're, that leads me to wonder a few things. One is, what's the problem with that? So why are we worried about whether somebody stays entirely in cash versus uses a formal financial institution or a prepaid card or some other place to save their funds? Which is, obviously a question that CFSI spends a lot of time advocating about, and I have opinions, but I'd love to hear what you think.
I mean, that's my question I ask my students too. I think it's very simple. I mean, the cash in the informal economy has much value. That's one point. You don't earn much value of your cash if you keep it on your pocket. Physically, the money is actually lost, and it's been proven that to be the case. Second is that if you mobilize your savings into a financial institution, you build a credit history. You increase a better relationship. I mean, there is a spillover effect, basically, of inserting yourself into the financial system that gives you the tools for economic citizenship. And, when I'm talking about immigrants, the fact of the matter is that you prefer, whether you like it or not, a wealthy immigrant than a poor immigrant, whether he's legal or illegal. So, economic citizenship is a priority within this context, and getting them into the financial sector is one. But forming their opinions and their practices about financial service practices is also another important component.
So, Patrick, I know the NetSpend card has a savings account associated with it. Mm-hmm. Can you tell us more about why consumers use that account and how it gets used?
Well, I think, like Manuel was saying to some degree, savings for the underbanked consumer is no different than savings for the banked consumer. They have the same needs, the same wants, whether they're Hispanic, African, Russian, or as I affectionately call gringo, right? It doesn't matter. We all have the same needs for some sort of savings. It may be for different reasons, but at the end of the day, we need savings. What we found is with our savings product, there is a very high interest in using that feature on our card. We have a very high take rate on it. The amounts that are saved are smaller, just because at the end of the day, our average balances on the card are smaller, and people are living paycheck to paycheck. So we pay on our particular product 5% savings rate, but again, our balances are smaller. So we do see consumers going into that feature, saving for a period of time, and then maybe depleting those savings for an emergency of some sort, to buy the tires for the car, or for a medical emergency, for whatever that may be, and then may go dormant for several months, and then they re-engage in the savings feature. And I think even banks are starting to see that. I mean, you see products out there where you save pennies every time you use. They round up to the nearest dollar, right? It's that sense of doing something for your future. And we all have that need and that want. And underbanked consumers have that same need and want. And so we try to facilitate that. And I believe as the industry moves forward, you'll see more of that going on. From an informal savings standpoint, Manuel was alluding to as well, savings conceptually in Latin America is huge, the concept of savings, but it's a lot of informal savings. It's having the cows, literally stuffing money under the mattress. That's not where they necessarily do it, as Manuel didn't want to allude to where. But it's really informal savings. So it's a matter of how do you move them from informal savings, not just Hispanic consumers, but unbanked consumers into formal savings, and seeing that advantage. I want to add one more piece to what Manuel was saying earlier as well. I think an important piece to getting consumers into the financial sector, into banking in general, or financial products, is also safety. At the end of the day, it's extremely dangerous for individuals to be carrying $1,000 in cash on them, or $3,000 under the mattress, and that's a big issue within the unbanked market as well.
So, say more about why consumers are choosing your savings account versus a banking account. And, are there barriers to using a traditional bank that you think your consumers are facing more than other consumers? Are there advantages to your product versus a bank? Like, how should we think about this versus a traditional debit card?
At the end of the day, our product is a debit card. We just make it more convenient and accessible for the consumer. So I don't think it's significantly different. We pay different interest rates than a traditional bank would. But we just really make the product and the service more convenient. We don't have the cost of having to build brick and mortar locations. We use retail establishments and partners to be the banking facility for deposits to occur. If you go to a website, whether it's ours or somebody else's in the industry, you'll see a lot of the same features you see in your checking account or in your savings account. You can see where you spend your money. You can see how much savings you have versus how much you have in your checking account, where the money's being spent. Text alerts that tell you exactly to the dime how much money is left in your account, which to my mother just flew in, actually. I'll tell you guys another story here, and I'll bore you some more. And I use my debit card continuously, and it drives my mother crazy, just absolutely bonkers, because she's used to withdrawing cash from the ATM or using a check and registering every single penny she uses. So we go out to dinner last night before I fly up, and I give my debit card. She said, no. I've got cash. And I said, no, Mom, it's okay. I can use this piece of plastic. And the cash, the lady takes the card, swipes it, and literally before she gets back, I've got an alert on my phone that says I've just spent $32 at, where were we, TGI Fridays, wherever we were, and I've got X amount of money left in the account. And I say, see, Mom, I know how much is left in here. This is how I track it. I don't have to write it down. It still drives her crazy, and she doesn't believe that that's the accurate balance. But so we're really, again, trying to provide services, features, functionality that are not very different from banks, just really more convenient, more simple, if that's a correct phrase to use, more simple, that a consumer with a high school education can understand and can value.
Sure.
What type of identification do you require? Because I think that's
Sure.
a big difference between mainstream financial services
It's not. It's exactly the same. At the end of the day, our product is actually issued by a federally chartered bank, and you have to have the same CIP requirements or stricter. The question was for the back, what identification or CIP requirements maybe, customer identification process do we have to validate who our customer is? I expanded a little bit on the question, but that's kind of where, versus a traditional bank, and it's no different. It's probably more stringent in the sense that the banks that we work with absolutely require us to go through those same processes and validate that I'm dealing with Patrick Brown and living at 123 Main Street with the following phone number, where the source of funds come from, all of the same information, because at the end of the day, we're actually opening up an FDIC-insured bank account for that individual. It just happens to be that they deposit their money at a grocery store instead of at a bank branch.
So I have one question that I'd love for each of you to take a turn answering to the extent that you feel like you have insights into it. And then I'll turn it over to our audience to ask more questions as well. Something that CFSI gets asked quite a bit lately is, what insight do we have into how underbanked consumers are weathering the current economy? We are regularly asked whether we can have insights into how this consumer is changing their financial transactions or experiencing and dealing with job loss or any other kinds of upsets in their lives. And I'm curious if you're seeing that in your businesses, and if you have evidence about how consumers are impacted by today's economic situation. James, you look like you're ready to start.
Sure. Well, yeah, I think that's a great segue. So we take credit risk. We don't have a charter, so we're kind of one of the, I guess there's sort of a difficult connotation now with non-banks, but we think of ourselves as a socially responsible, innovative non-bank lender. But what we find is, like I said, that distribution of people across FICO scores, because even if we talked about credit history, if you have your money in the banking system, actually you could have your money with Bank of America for 2-3 years, and that doesn't actually build you a credit history at all. And that's what really gets Jose and Maria upset, because they're putting their money and they've got a lot of pride and they think they're doing everything they're supposed to, and then emergency comes, car breaks down, hey, and the bank's not there for them and says sorry. And they say, what's this about? I've given you my trust, my money, and you can't even give me credit. So they take all their money out and they go back to the cash economy. And so why is that? Well, and what are we seeing with this trend in the economy? So 50-60% don't have a score. Unfortunately, the next big section is about 35% have an average score of 570 FICO. So that's very, very low credit score. Only 10%, or actually less, 5 to 10% have over 660 FICO. Okay, so basically, if you think about where is all the credit going to get extended and where is all the innovation going to come, banks won't touch this market because 90% of it is just either 570 average FICO or no FICO, and they don't, especially in this environment, they're not going to be making any loans. And if you break up loans, you've got mortgage, unsecured. So what we're seeing is people are more strapped right now. If unemployment's going up, we're only lending in California, and some reports are 18, 22% in parts of LA. People are having a very hard time right now, and when they need some basic, $300, $1,500 to get to some life event, someone gets sick, what do? Banks aren't there for them, and really there's no real non-bank innovators. There are non-bank payday lenders that are out there, and they'll go to them, right? And so that's kind of the only option, unless you can borrow from your friends, but they're probably also strapped. And so we're seeing a little bit of a deterioration in FICO scores, unfortunately, over the last 6-12 months. Times are getting tough. We have to call people and remind them, hey, this is your first chance. It was important. You've made your last kind of 6 payments, but what's happening now? Oh, I've lost my job. You have to deal with that. So we're seeing it. It's impacting a lot of people. And I would just raise the question, and be concerned. I think a lot of progressive, transparent regulation is great, and we should do that. But let's also ask ourselves the question: are we going to help people more or not? And will credit be less or more available as a result? We do want good products, but you also want people to have somewhere to go. Ideally, more socially responsible kind of innovators. And so maybe the question is, what can we proactively do to encourage that, as opposed to potentially discourage that? And I think that's what I would be concerned about in this time of economic recovery.
Patrick, do you want to
Sure.
take a stab at it?
I think what we're seeing in the industry in general is we're seeing more consumers moving into prepaid debit specifically from banking products, actually. A lot of the information we get back is that the product actually allows the consumer to be, they actually have studies, they actually use the phrase babysitter. It doesn't allow the consumer to spend more money than they have. And it really allows them to know down to the dime how much money they have left on an hourly basis. And so it's unfortunate, I guess, that the downturn has actually seen more consumers move into prepaid debit, but we are seeing spend amounts or transaction amounts decreasing. So the amount of money that maybe the consumer spent in different categories, grocery, gasoline, et cetera, we're seeing those amounts decrease, and those monies trying to be spread over more transactions. So transaction amounts increasing, or frequency of transactions increasing, amount of money in each of those transactions decreasing. So where an individual may have filled up their gas tank before, now they're only filling it a quarter of a way or half a tank, and we see them going back more frequently to that location. So it's really around cash flow issues that we're seeing in the downturn, and that changes. Like many of you, we've seen a great increase in transactions at discount stores, the Family Dollars, the Walmarts, the Dollar Generals, et cetera. And those are all also smaller dollar transactions versus at department stores or different areas like that. So we are seeing the underbanked consumer affected by the downturn, and really what they're trying to do right now is manage their cash flow.
Thanks. John, do you want to add to that from the perspective of refinance loans? And I know you've done some research with Peter Tufano that would probably shed some light on how people make their spending decisions over time.
Sure. Maybe two things to add to that. It's sort of interesting, a couple of dilemmas within these particular segments. One is I think really the issue of price sensitivity for the consumer. Is the consumer price sensitive? Will they shop on price? Are they aggressively seeking other options? Do they have the experience, education, and the access? It's another thing we can discuss to really go find low-cost options. Within the tax preparation industry, or at least within the refund lending portion of that industry, that's been a real concern. Could you just basically charge whatever you want? If the consumer has no other options, where else are they going to go? The industry really saw, I think, in the last tax season, the first indications of a shift away from lending to more of the deposit-based solutions, without a real, frankly, without a real quality explanation for why that occurred. But maybe the first indication that some price sensitivity may have been coming into the marketplace from the consumer perspective, which was really interesting to see. One of the things that also have been concerned about as it related to these issues, it's very hard to build a well-structured, healthy product that makes money and can be delivered affordably. It's very tough to do. It's much easier to sort of put a retail check cashing store and have a high fee-based model that drives some measure of profitability. But it's very tough to do, and you've got to operate at measurable scale in order to make in order to have a really sustainable and manageable business, which is really tough to do. And I thought that some of the larger organizations in this country really would have a real opportunity to make a difference in doing that. But it's different than their traditional business models. Their traditional business models is different than retail branch banking or credit card delivery, and so it's really going to take investment. And I don't just mean money. I mean brain power, testing, trial, and learning from the large institutions who have an opportunity to get to a scaled set of solutions that will work on a broad basis across the country. And will they do that under the current economic situation, and will they do it under the prospect of regulation that they may not understand? And so I think that's to echo James's point, is something to really watch for, because those are the organizations that have the resources to really change this particular game. Rachel mentioned a set of work. All I really did was give them the data, but Peter Tufano and Sean Cole at Harvard did, which I think was a really interesting analysis of how people spent their tax time money. And I certainly think within the organization that I was working at the time, it was a belief that a tax refund was luxury, was entertainment. And we had really no data on that at the time, because everything went out in checks, and those checks were cashed, and the cash was spent. So you could survey people and ask them, but was that really true? When we put those into bank accounts and then tracked where people spent their money, it was everyday consumables, bills, grocery, gas station, average purchase prices of $40, $50. Certainly some comes out in the form of cash, but it was spent on the things that a family needs to survive every day and every week. And it was a very illuminating piece of information for policy work as it related to lending in low-income communities. The paper's called "Where Does It Go?" and easily findable.
So I see we have some questions in the back.
Hi, Ruth Sussman with Consumer Action. I had a question about the prepaid debit. Are there protections with the product that you offer for lost or stolen cards? And what about if there is a billing error, if there's a problem with the balance? Maybe you haven't seen it, but there might be one in the future on some card, a billing error.
Yeah, there are. I mean, the products are all Visa or MasterCard driven, so the same protections, features, and functionality that you may have on your bank debit card are exactly the same features and functionality that you would have on your prepaid debit card. So whether it's lost or stolen, or you identify it as not being your transaction, all those same pieces of protection fall into a prepaid debit card as well.
Just add to that, Patrick. You all worked hard to make it work like that. And not every card is the same or as well structured as what's happened there. So and this is, in having worked around this field some too, there's a lot of, or certainly felt like a lot of gray area in terms of what you had to do, what you could do, what you should do, and so is this thing a bank account or is it not? What features, functions do you have, do you not? And so I think. Well, you all may be a solid example of a really well-structured structure. I mean, the back-end structures in terms of consumer protections and things like that. Whether you can say that it goes across the entire prepaid industry may be something different.
And that's true. I mean, at the end of the day, as I mentioned earlier, there are different categories within prepaid debit and different companies that provide services. But at the end of the day, we view our product as an alternative to a bank account. So we compete with banks on a daily basis. Many of our consumers are banked as well, and have the option to be 100% banked if they would like to, but choose to use our product for different reasons. So we really structure it in the sense of giving all those protections to the consumer, and I can't say that that's the same for every company in the industry, but the consumer does have choices. The consumer is smart, and really simplicity at the end of the day drives a lot of the actions that the consumer takes.
Let's see. Yeah, another question there, and then we have a question in the front.
Hello, Rachel. Renee Bryce, Laporte Aspen Institute. I guess it's mostly for Patrick and James, but others can answer if they'd like. I work mostly with rural America, and I'm wondering, to what extent are you working in rural communities, and if you're not, do you want to?
I'll take the first one. Well, we're just in California today. We are in like Central Valley, Fresno, Bakersfield area. We are in Salinas, Watsonville. But no, we'd love to. We're going to be expanding, as I said. Our goal is 1 million customers. We really want to make a dent. This problem is 80 million underbanked. There's about 25 million are Latino. We even serving 1 million sounds big for where we are today, but that's just a small dent on the problem. So we hope to be in rural communities and other states very quickly.
Netspend specifically is around the country. We've got over 40,000 locations where the product is sold, over 90,000 locations where the product can be reloaded, we call it, put money back onto the card or money deposited onto the card. So we're throughout the country in many cases in rural areas, but obviously urban is probably a denser population for us. So. Yeah, but we are very interested, so as other companies probably are as well.
A few questions here.
Good morning. Andre Bhatia with Acon Investments. We're a private equity fund that's looking to invest in companies that serve the underbanked population, both in the United States as well as in Latin America. And we're looking to invest, $15 to $50 million. What advice would you give me in terms of subsectors of this industry, and what risks should I be looking out for? So any advice that you have, I'd love to hear.
We probably need a couple days to sit down and chat. I don't know if anybody specifically. I mean, there are a number of different areas, obviously, that to go into, but socially responsible lending is definitely one of them.
Actually, yeah, and Patrick and I have talked a lot about ways maybe we could do that together. But so, 90, as we said, just on the credit side, 90% left behind. Prepaid. You're hearing the trend as people are moving into prepaid. That's because banks right now are, one, they're in trouble, and two, it's probably the last thing on their list right now to go and serve underserved communities, given where they are right now. And so there's a big opportunity, but hopefully we find socially responsible or companies that are going to try and to John's point, do it the right way. And I think there's a big opportunity, but it's not going to happen from banks, and it's going to happen from companies that are out there building a relationship in a different way than banks do, and ideally a higher trust relationship. So across all segments, prepaid, credit, tax related.
Just add one thing to that. I think that when there's the product gap, and you can solve the product gap, right? So we need an account, or we need a savings account, or whatever, or we need a loan. We can build that. The product gap, when it's there, feels like the most daunting thing, right? If we could just build the product, it'll work just fine. But one of the things that we had found is, at least as it related to financial services products, especially ones that are used more than once, or there aren't single focused in a transaction. The harder part of the transaction is after you got the product built, and after you've got the distribution arranged, and can you connect with a consumer and build trust and deliver. And so I think in terms of investing in products, I think that's one of the things that I pay a lot of attention to is does the company have, the leadership have the kind of experience or access to resources to sort of close that last part, which is way harder than building the product, even though the product is really hard to build.
Right. That's the last 20 yards, using a football analogy. That's the red zone.
Yes.
And probably the most difficult. That's a great point.
Yeah, and I'll add one point to that. CFSI should say it has been an investor in this space in addition to doing research. And one thing that we work hard on and are continuing to work on is how you measure what your impact has been. So if your goal is for it to be an investment that not only is successful financially, but moves the industry forward, helps consumers in measurable ways, then it's important to develop some metrics around consumer impact. And we're thinking hard about that, and we'll continue to work on that part of this equation. We have a handful of questions. Why don't we start here?
Hi. Dave Wilkinson from City First Enterprises. We're a nonprofit bank holding company of a CDFI bank in D.C. I am interested. John mentioned the fee he charges for his core services, I think $20. I'm interested in what sort of fees you guys charge and what considerations go into that. Obviously, one of them is your investors and the sorts of rates of returns your investors demand. So not unrelated to the last question is, so I'm interested A, in your fees, and B, in what types of investors do you have, and what sorts of returns are they looking for?
Let me go first. The types of fees we charge are really, there's two pillars. One is, and they're not dissimilar to the way banks used to charge fees as well, is one is in when you go to deposit your funds at a retail location, that institution will charge you to deposit funds to use their location as a branch, basically. That ranges anywhere from $1 to $3.95 is probably the max that the industry not allows, but that the consumer is willing to pay. The average is probably about $2 for a deposit. And then for card usage, there are two different ways that the industry generally charges. One is on a per transaction basis. So if you're an infrequent user, you may elect to go that route. So if you only use your card once, twice, 3 times a month, it may be a high school student, a parent gave them a card, they use it at the coffee shop or go to the movies or whatever it is. Or if you use it on a regular basis as your bank account, you have the ability to choose what we call the Fee Advantage plan. That ranges anywhere from $3 to $9.95, depending on the company, per month. Yep. And then you also have an annual plan that some companies offer that you can pay a flat annual fee to use the product all year long. Our average fee that consumers pay compared to what they would pay in a bank environment is approximately $175 a year for the usage of the product versus approximately $500 to $700 in a bank environment for usage fees that they would encounter for low balance type consumers, just as a comparison.
And that delta is probably driven by non-sufficient fund fees that banks charge, right, I'm sure. So on our end, it's the story of Progresso, and I think to John's point about scale, you really need to get to scale to make these kind of business models work. We still don't make money at Progresso. We're closer to it. So as when I was at Stanford B School, it was my MBA project. We're now 100 people. We've got a great team, but we've had to raise about $25 million of venture capital, sell off big pieces of the company over time. And we've got Greylock partners invested in Facebook and DoubleClick and now Progresso, right? So we've got a lot of great Silicon Valley backers, great investors. But I think the main point is, and back to what we charge consumers. So we've been trying to make this work at what people would like to see it at 36%, kind of all-in APR. We charge 26% on our outstanding balance, and then a fee up front. So when you combine them, about 36% APR. The next best option, or actually the only option available to people, is 470%. Average varies by state payday loan. So we're trying to do it, at a much lower price. And I tell my friends and even say, "Oh, 36, that sounds high." But the reality is, it's either no credit or 470, or now 36. And what we do that's different is we report your credit. So we help you build it so you can now access better options. And then on subsequent loans, we kind of lower your rate. So, but that still doesn't work, right? So you need a lot of scale for this type of business. And so I think as we think also, I know the next panel is on policy, it's given that all the innovation and all the products come from the non-bank that serve all the people we're trying to solve for with consumer safety commissions, et cetera. It's all the lower income. What can we do to encourage more innovators to get to scale, right? So they can really take pieces off this 80 million. And what proactive policies can we do to encourage that? Because if you don't solve that, you're going to leave people farther and farther behind. So I think they're all related. The idea is to get to scale. Those are our investors, and we're trying to do it the right way.
And I skipped the investor side. I apologize. I didn't mean to. But our company was founded by a great individual, Roy Sosa, who's here. He's going to be speaking later. great vision and private funding, and then later private equity invested into the company. And really at that point it's really, again, around getting to that scale, and the amounts of money that's needed to be able to get to that scale is usually not done by one individual. So
I think we have time for one or two more questions. So we have two hands up, I see, or I see three hands up, and then we'll turn to the next part of the agenda.
Somewhat of a big question. John Ryan with the Conference of State Bank Supervisors. And for background, the states regulate both the banks and the non-banks, and we've been having a very active debate around this issue. But the whole language, even around this discussion, unbanked or underbanked, sort of assumes that being banked is better than being unbanked. And there was a question to the panel about the financial health of the unbanked, and what we're seeing is a little bit more gray, in that in some cases the unbanked may be in better financial health. We see a lot of stress throughout the system than the banked, when you sort of layer on credit cards, the complex mortgages they have, and overdraft fees. So the fundamental question, this gets at the CFPA and all of this, is do we really need a banking model to have affordable, sustainable financial products, or is it only going to get there through a federalized system? Are there other alternatives? It's something we're debating.
I guess Manuel's ready to go, as is James.
Just briefly, I think you're raising a very important question. Normatively, having access to a bank is better. Empirically, it's probably not. And obviously, if you base simply your decisions on the facts, you may have problems in the future, because after all, you need to reconcile norms with facts on these issues. But what is happening, there is an organic shift, a significantly important organic shift that is associated to the financial crisis, in which consumers, the average American, not only the immigrant population, is increasingly reconsidering the way in which they are managing their debts, their consumption, their expenditures, and their savings. The fact that people are increasingly going back to save and then returning to how to manage their debt is an important consideration that cannot be missed in this process, especially in the long term. Associated to that, the demand of financial services that people, on the average, are having are increasingly becoming more distant from the current financial services that the conventional bank offers. So there is an emerging group of what we can call microfinancial institutions that are coming across the United States in different forms, whether it is to offering debit cards or other type of products with their own store locations, that are predominantly agglomerating at least 5 different kinds of financial services that are basically responding to this shift in demand. And the question is going to be how regulation is going to accommodate and adapt to these realities, and how the conventional business model of banking through credit card debt and corporate banking is basically going to have to also adapt to this changing reality. There are signs that some financial institutions are doing that, but this is just the beginning of a major shift that is going to take 30, 40 years. But we are in a direction where there is a different approach by the consumer about how to handle your finances, and it's not going to be credit card debt.
So I know I both want to answer this, but we also are supposed to wrap up right now, and I know we have 2 other questions. So if you don't mind, I'm going to ask you to let us move on to the next question, which I think will be our last one, and then we'll move on to the next session. Yes.
Tamara Duggleby from Duggleby & Associates, Small Business Banking Consultants in Washington. My question is for Patrick and James, and that is, what was the break-even threshold that you had to reach in terms of number of clients when you launched your premier product?
A lot. Break-even happened way before I've been at the company. Roy founded the company in 1999. Did a phenomenal job at growing the company, but it's hundreds of thousands of customers. that we had to be able to serve before we could get to break even. We are in the millions now, so it's a mass quantity of customers that you have to be able to serve because the dollar amounts are very, very low.
Okay. So 2 points. So first on that one, we estimate it's about 100 to 200,000 active customers that you have to have to break even on the lending side at 36%. So you really need to get to scale. The point earlier, our loss rates are single digits. So you think about where banks are now, credit card is over 10%. So who's serving people better, right? People pay well. And if you think about regulation, all of these products, a lot of them, when they get to scale, they're all offered through a bank. So, NetSpend issues a card, there's a bank behind it as well. And so those banks are also, regulated, obviously, by the prudential regulators. And just as you think about kind of where this can go, one thing on policy, if you're going to do CFPA, why not give people a federal license then, right, on the other side of that? But where this can all go, so a guy named A.P. Giannini, San Francisco, set up a booth after the fire and the earthquake, started lending to Italian immigrants, called the Bank of Italy, became Bank of America. So I think there is a path that we can build all of our companies to ultimately, break into the mainstream and bring this customer all the way through, and that's what we want to do.
So thank you, everyone. I appreciate your participation. Thanks to that.
All right, is everybody in for the long haul? Thank you. So we're now, your questions were anticipating the next two sessions, so the next speaker as well as the final panel. Both what is the business realities of serving the underbanked population, as well as what are some of the policy implications in light of these models of business. But I just want to capture a few things that I think we heard from this discussion, which really was to present the realities that this is by no means a homogenous consumer segment that we're talking about. But nevertheless, there are some consistencies we see throughout, which clearly are going to play into some of the economics and the business considerations. We heard across the panel, these are consumers who are saving. They're just not doing it in the traditional ways. They keep generally very low balances. We heard that with the prepaid card. More intensive underwriting, and generally some lower credit scores. And so I think we need to keep all of this in mind, as well as the preference for non-traditional hours in terms of conducting their financial services. So keep all of those in mind as we next welcome Roy Sosa, who was mentioned a couple of times. He is the co-founder of the Socially Committed Venture Fund and affiliated business accelerator. This is Empower Ventures, which the portfolio spans international payments, mobile payments, asset building, and retail financial services operations in regions across the globe, including North America, Latin America, Europe, and Asia. Mr. Sosa is an accomplished entrepreneur who pioneered the multi-billion-dollar prepaid debit card you've been hearing about, the NetSpend card. It's a very highly successful company that's serving millions of underbanked consumers throughout the U.S. So without further ado, Roy, do you want to come on up?
Thank you, Melissa. And thank you, everybody, for joining us this morning. It's always a privilege to be here and in front of people that care about the underserved, and in front of policymakers, in front of entrepreneurs. And I say it's a privilege because 10 years ago when we started, we couldn't have dreamed. We couldn't have dreamt how big, how important this was going to be. I will never have guessed that I was going to be, for example, in Davos talking to the likes of Bill Gates and telling them how payments for the underserved was actually part of a solution to the global financial crisis. I would never have imagined that our customers would get into the millions, and that the little transactions that we were trying to solve for were actually going to be so meaningful for them. The multiple letters that we got where people basically said, this product has changed my life. And how we became, when we first started, it was about getting a company that was going to power payments on the internet, hence the name NetSpend. And over the years, we thought, well, we're no longer in the plastics business. We really are a processor. And then we evolved in our thinking, personal thinking, and said, we're processing hundreds of millions of transactions. There's a little bit more than this, and we could really have an impact on these customers. I know earlier on, Patrick did a phenomenal job talking to you about the savings program, but I wanted to give you a little bit of color, a little bit of history as to how that came about. And a lot of think tanks and policymakers have asked us over the years, why don't we see more savings programs? And the answer is that it was not a program, also not unlike the company itself. It was not something that we came up as MBA graduates or analysts. My brother and I, when we co-founded the company, was in a one-bedroom apartment in Austin, Texas, with $750. A lot of people have heard or written about it. But really, we started as customer number one, number two. We are immigrants. We are also Americans. We were students, going from paycheck to paycheck or student loan to student loan. And for us, it just seemed that, if you're in college and you think that you have at least the level of sophistication to deal with bank accounts, why is it that my bank doesn't give me the service that I want? Why is it that I can't go out and deposit my $2,000 check from financial aid and at the same time go into Amazon and buy books right then and there? Why do I have to, if I deposit the check on Friday, why do I have to wait until Monday at midnight or Tuesday? It just didn't make sense. And so for us, really, it started about trying to find that convenience. But it wasn't, again, the business plan, it was more of a personal need. And later on, in 2004, the savings program, it was also about a personal belief that we said, Bert and I were talking about this. We were saying, remember when we first started engaging in 401ks? Back in our days when we were doing telemarketing at MCI. Remember how we used to say, I can't afford to depart with an extra $20 because I need every single dollar I need for whatever, pay rent, pay bills, go have fun, and I need it now. And you don't think that the $20 is going to make a difference. And then all of a sudden, you say, what the heck, let's go ahead and sign up. And we sign up at the highest numbers, and then our company starts matching, and we kind of forgot about it. And then a year later, it's like, wow, where did this money come from? Mm-hmm. And it was that moment that we said, we should replicate that for our customers. We had board meetings, and they thought at what point, they said, well, it's a novel idea, but where's the ROI? And not really sure that I can pinpoint it. I don't know if there's going to be an ROI. I know we're going to have to spend hundreds of thousands of dollars programming, and we're going to have to spend a lot of time on the legal side trying to figure out how do we make this compliant. And yet and nobody's ever done it, and every time you want to do something new, it's painful. When we first launched the debit card, we felt that the card had to have consumer protections such as FDIC insurance, such as Reg E. But when you looked at the store value laws of 1997, you see that Reg E doesn't apply. FDIC insurance, it doesn't apply because it's not really a bank account. So we went to the extent of going to the bank and saying, we will get securities to insure this product. Why? Because we felt it was the right thing to do. We are going to go, okay, we like the fact that Reg E doesn't apply because if we have to mail statements, this thing breaks. But we're committed to the spirit of Reg E, which is we're going to go out and we develop ways, whether it's online, via the mobile, for people to be able to see how much is spent. And as Patrick said, it's super easy. It's actually better than the statement because when you get the statement, a lot of time already passed. It's dead information. Here it's like here and now, and it's accurate. And it's easy to understand no matter where you are. And so that for us sort of brought us back to the savings question and said, will they save? I don't know. I had to tell my chairman, I don't know if they will save. But I tell you what, I'm willing to put my own money, my own cash, and if this flops, you can just take it out of my... Why? Because, and I think the principle there, as we look at entrepreneurs and as we look at companies, is that we got to go back from, in financial services, we got to go back to those days of Bank of Italy, of that small community bank, of the Henry Fords, and we have to say, is there passion for what you're doing? Do you have a passion to serve this customer? I wanted to show you a picture of what I now call my friends, Maria and Dominga, and I'll tell you a little bit more about them, but they're two ladies in Chiapas that are using our products, mobile payments, in Chiapas, where people said, you know, you can't bank those people, similarly to what we were told 10 years ago about the underserved. Well, back to the savings question. So we just decided, let's go for it. Fortunately for us, our CEO at the time and our board at the time, which actually remains pretty much the same board, said, all right, what the heck? Let's do it. I mean, it can't hurt, right? What's the bad? Lo and behold, the customers actually engaged in it. Lo and behold, for distribution partners, it was a great thing because back in those days, our main distribution was check cashing centers around America, and I know a lot of you, if I ran into you 6 years ago, you would say, Roy, but you're so passionate about the underserved and you're about empowering people. How can you do business with those people? How many times should you wash your hands before you kind of come out and say, guys, that's where our customers are. Let's not pass judgment. Instead, let's try to figure out, and let's also try to figure out those entrepreneurs that are running those check cashing stores, give them solutions, give them alternatives, because I don't think anybody in check cashing arena wakes up like, how am I going to try to stick it to the customer? That's not the purpose. So now we have a national savings program with FISCA, and the program takes off. And the figures were already discussed as far as the adoption. But the main thing that happened was customer retention, and really for the company to position itself to the customer said, A, we care. B, we're going to make it easy for you because savings is not, I know Patrick said it earlier, so it's something that we all aspire to do, but that's almost like losing weight or working out or wanting to quit smoking. I mean, we all aspire to do a lot of these things, but the reality is that it takes discipline and it's difficult. And when you have to make a purchase or you have to make decisions every day, micro decisions, you're gonna always err on the side of the you of today instead of the you of tomorrow. And so what we did is we went back to that moment where Bertrand and I were thinking about 401ks, and we said, let's make it easy. Let's just make it where the customer registers, and at the point that they're loading, automatically X amount of money goes into the savings account. Or they can determine the amount, or they can determine the percentage, and it's out of mind, out of sight. And any money that is there, there's no fees. Actually, they make interest. And then we start thinking, well, you know, we can partner with the bank. The bank can pay some interest. We can pay more interest because guess what? Neither bank nor us are paying for branches. And those of you in banking, you know that branches are very expensive. And it's not because of the real estate. It's not because of the technology. It's actually because of the regulation. Because the vault has to be of a particular way. Because the distance to the doors to the vault have to be the particular way. Because everything has to be certified. And then you have to wait for the regulator to come in and tell you that your branch is built the right way. So as we think about this, and as we get into the next panel and start talking about policy, what I'd like to share with you is that it's something that was said earlier. Let's support entrepreneurship. Let's support entrepreneurs that have a passion for the customer. Let's also go with what are these laws that we created either today, last year, or 100 years ago. What is the spirit of those laws? So, for example, Reg E, why do we have it? Why is it important? And if we take that, and then we take the technology of today, the processes of today, and the reality of the customer, then we can come up with better regulation. But to me, as we now have expanded across just about every continent, say for Africa and the Middle East, I've come to truly appreciate what a wonderful country this is from a regulation standpoint. I used to pull my hair and say, oh my God, I got to deal with 50 state agencies that are going to tell me whether, do I need a money transmitter license, do I need a seller checks license, do I need, every single type of license that we need to have. Is it a deposit taking operation? Is it not? What is the agency between the bank and the retailers? And that was very painful. But on top of that, I have to deal with the OCC, I got to deal with the OTS, I got to deal with Treasury, oh, by the way, DEA, Secret Service, and every other law enforcement that also thinks, oh, these products are going to be used for money laundering. And now, I go out to other countries and I realize that the most the fundamental treasure that we have as Americans, aside from democracy, liberties, and everything that we love, apple pie, we have a legal system that basically says that unless it's forbidden, you can do whatever you want. Spurs innovation. And oh, by the way, we can always go back and see if what you did was harmful, and then we can adjust it. And I know right now we as Americans come under a lot of pressure because we say, see where that took you with the financial crisis. But no, really, I will take the hit that we took in the last 12 months if that meant that we got to keep the progress that we made over the last 200 and so many years. So as we look at countries where we try to launch our programs and people tell us, well, it's not on the law, you can't do it. You can't even think about it. And law has to be changed by Congress. Very difficult because in the end, you can't really go out and give customers like Maria and Dominga the opportunity to engage unless you really do a lot of work up front. When we start thinking about new products and the policies that go with it, we have to come to accept that the products are going to move faster than the policy. It's 10 years ago, and we're still talking about the same things that we were dealing with. It's 10 years since we started. We're still dealing with a lot of these things. So is it a bank account? Is it not a bank account? Should it have this or that protection? And the reality is, it is a bank account. Our biggest innovation, it took us this long to realize it. It wasn't a prepaid debit card. We didn't create a prepaid debit card. Prepaid debit card is a debit card. We just went to MasterCard because at that point, when we showed up to MasterCard 10 years ago, they said, you can't charge for selling, you can't sell a MasterCard. The MasterCard belongs to the issuing bank and actually to MasterCard. So we can't allow you, it's against our franchise rules, you can't sell a MasterCard. So, well, but what about a prepaid MasterCard? Huh? What is that? Well, it's something that we're going to create. It's a prepaid MasterCard. And all of a sudden, you give it a new name, and all of a sudden, you can do new things with that. But the reality is, it's a debit card. As Patrick said, the difference is that it gets reloaded not at a bank branch, but at retail. The difference is that I can walk into a grocery store, a convenience store, at midnight on a Saturday, and I can open an account, and I can reload an account. That's the magic. We created the American version of what Brazil, Mexico, Colombia have been doing, which is branchless banking. We've created 10 years ago what M-Pesa right now is doing in Kenya, and everybody's saying, wow, what a fantastic... We've been doing that. We just called it prepaid, but the reality is branchless banking. That's the crux. And so, okay, so should we regulate the point-of-sale terminals at the retail stores? No. The point-of-sale terminals technology will evolve. And today, we're using point-of-sale terminals that we connect to the data center of, say, a Walmart or a CVS or a check cashing store. That's going to change. Tomorrow, maybe cell phones. 10, 20 years from now, it may be implants in somebody, in the head. I don't know. We don't know what it will be. And so our laws have to remain as rich as they've been since we established this country, which is basically our Constitution is like 2 pages. And if you do the font small enough, you can get it in 1 page. Constitution in other countries is like volumes. And people spend time, years, going back over these little nuances. For example, you try to launch a prepaid card in Mexico, for example, and, well, you can do this type of transaction, but not this type of transaction. And, oh, by the way, if you're going to reload it, the reload agent has to have a 2-factor authentication that has this encryption and that encryption. It's like, where does that come from? So In any case, I just wanted to give you a little bit of that historical context, because as we go out and embark in trying to define the types of policy recommendations that will be issued, and particularly when we start thinking about consumer protection, it's extremely important that we understand what are going to be the consequences to the customer. We heard earlier, are we going to push people more into the informal economy? Give you another example. Talking to the likes of DEA 4 or 5 years ago, we said, hey, look, the weight of a $100 bill is like half a gram. And so if you want to smuggle money out of the country, it becomes very heavy, very difficult. On a debit card, people can move money in and out. And I said, yes, that is true. But don't compare the prepaid debit card to a bank account. Instead, you should compare the prepaid debit card to cash. And do you rather have these criminals operating in cash where you don't see it? Or do you rather have them in a place where we are able to monitor and catch them? And so the answer after several years was absolutely, we want to be there. So in any case, just wanted to share this bit of stories, and I think my time's up. So at this point, I'll put you back with Melissa.
Thank you, Roy. We've got time for one question for Roy. Any hands? All right, we've got one question, and then...
Maybe just a quick one. You talked about both the kind of transaction, sorry, Peter Mitchell. You talked about the kind of transaction facilities of the cards and the savings facilities of the cards. Is there any plan to use kind of the innovation there to promote sort of micro-lending, as happens in some developing countries, but to people? I know one of the issues in a low-income area in England, as you'll probably tell from my accent where I used to work, was people couldn't afford durable goods, whether it's a dryer, washing machine, even television. We're getting these rent-to-buy schemes where they're paying exorbitant interest rates. Are there any schemes to kind of promote micro-lending through the cards and the facilities, say loans up to 2 times their saving balance or something like that? Or could you just talk about maybe some of the issues around there very quickly, I think? So, yeah.
Super quickly. I said it earlier, and it took me a while to sort of step out of the way to say it is a bank account. If you think of it as a bank, actually think of it as a bank account light, a portable bank account. You go from cash to prepaid to traditional debit and then everything else. And the idea initially for partnering with banks was that we can create that ladder to move up into full financial citizenship. I've heard a lot of analysts talk about how, this actually keeps people from getting bank accounts. That's BS. It's like, it's a step. It's almost like saying, if you step on the first rung of the ladder, you won't get to the second one because you may just get comfortable there. That's not true. But so to your answer is the following. If you think of it as a bank account, then the following are natural avenues. So microcredit, microinsurance, savings, mutual funds, and every other relationship building type of product that a bank would ever want to have.
Thanks, Roy. You're clearly making pretty powerful statements and arguments around the need for access, and that's something that we're going to talk about. But there is also the need, whether it's a loan that's attached to a prepaid card or other relatively high-cost financial services, for a balance when we do need to make sure that there are protections in place. I'm wondering if you have any thoughts. We heard Peggy earlier today talk about the way the CFPA is being proposed. It's around regulating around product. If you think that that's maybe getting the regulatory scheme a little closer to being able to anticipate what some of these innovations are, and then being able to react appropriately to allow access, but also to make sure that we've got protections when we do see things like loans being attached to prepaids and other types of vehicles.
Right. It's interesting how innovation, in my opinion, will always move faster than regulation. And so as a result, the biggest challenge against high fees actually comes from new products. So for example, one of the biggest accomplishments, one of the things of which I'm most proud of, is being able to take an industry, i.e. check cashing, that used to charge 2 to 3% to cash a check, to be the champion of direct deposit, where the customer pays zero. Zero. So how do you go to a publicly traded company like Ace Cash Express, who's charging 2 to 3% for cash and checks, and you convince them that it's better for them to completely change their model and go into direct deposit? That is transformational. And so when you start thinking about, well, what about the 400% APR? And the debates in Congress and at the state legislatures have been endless about payday lending. And said, it's too serious, it's horrible, and they're really hijacking the national powers of OCC charter banks and blah, 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 blah. And we saw what Gonzalo is doing, 36%. That is what's going to kill the 400% APR. And so I would say the important regulation is not so much trying to regulate the interest rate, it's trying to regulate the, hey, clear disclosures. Because going to the customer and putting the little fine print, charging for fees that people are not used to, they don't even think about, so for example, declines, or for example, customer service. I mean, those things just simply are super fine print that you don't even really think about, even if it's printed there. But if you say, well, when does that happen? Yeah, so disclosure for me would be the place where we would focus on.
And that assumes that we can get adequate disclosures that are plain English or Spanish enough that consumers ultimately understand it.
That's right. And well, that you take me to the other one, which is not necessarily regulation, but incentives. So as human beings, our behavior at 35 years of age, 40 years of age, what's acceptable is very different than, say, when I was 2 years old. When I was 2, I could ride on the walls, run around in a diaper or whatever, perfectly fine. Well, for companies, if you have millions of customers, I would throw it out there, and I know, this impacts a company that we co-founded, and I've actually been very proud of what they're doing. But I think that as you get to a certain scale, you do have a certain responsibility for things that are not written in law. So, for example, should companies that have over X amount of clients, I don't know what the number is because you got to make sure that it's sustainable, but should you have some sort of CRA component where especially if you're serving the underserved, should you have that? I would say yes. Does it have to be written into law? No. But should you, as the government, provide incentives that would that for the likes of John or Patrick or Gonzalo, for them to figure out, hey, there's this incentive over here. We have incentives for green energy. Why should we not have incentives for CRA type of behavior? Those would be the types of things. And if you start doing that, the low-hanging fruit in terms of CRA is financial literacy. Make sure that it's not just, hey, here are the instructions and here are the fees. Let's really work with you, because if I educate you, you're going to be a better customer.
Thank you, Roy.
Thank you.
Great. Thanks, everybody. We're now going to turn to the conversation around policy, and we're going to talk about what some of the implications are for some of the insights that we've heard today. We're going to explore how federal policy can support responsible and innovative alternative financial services, and how the financial services needs of underbanked consumers fit into this broader discussion around re-regulation. Before we dive in, though, I think it's worth pausing and acknowledging or recognizing that there really are 3 critical imperatives to effective, good financial services policy. We've talked about them in various ways. They include ensuring adequate consumer protections, providing for financial access, and guarding for the financial health and the stability at the institution as well as the industry level. So as policymakers, and we're seeing it happen now, set about crafting legislation and regs that either intentionally or inadvertently emphasize one of those 3 legs to the stool, I think it's really important that policymakers also consider what the implications are on those other 2 legs of the stool. Whether that's the Credit Card Act that recently passed is in a very important milestone around consumer protections in credit products, or if it's the CIP, the Customer Identification Program requirements under the Bank Secrecy and the USA Patriot Acts, which are ultimately getting at safety and soundness issues for institutions. As movement happens in one of these, we really do have to think about what the interplay, what the complementary and at times counterbalancing policy measures are needed. So in this final panel on policy, I'm going to be joined with Bill Zavarillo and Ed Mierzwinski, and I'm going to spend my time focusing on some policy ideas that we've been developing over the past couple of years that really focus on promoting access. Utilizing some of the learnings that we have from the non-bank financial services to tee up some policy ideas that promote access to financial products and services from transaction to savings. And then I'm going to talk about a credit idea as well. You're then going to hear Ed Mierzwinski from US PIRG discuss the importance of consumer protection. He's a noted expert on this topic and has testified repeatedly on the issues, and he's going to talk about the role that policy will play in ensuring that adequate consumer protections are a big part of the conversation that's going on now. And then he's going to be followed by Bill Zavarillo, who's going to address this issue of balancing these three different imperatives or legs of the stool as policymakers go about the financial re-regulation process. So diving in, the first policy proposal I want to present to you today is one that utilizes tax time to promote access to an affordable, responsible transaction and savings product. Over the past 2 years, we at New America have developed this policy proposal that would literally provide millions of lower-income tax filers with an account literally on the tax form. This account would consist of a prepaid debit card, similar to the NetSpend product that you heard today, and it would serve as an alternative to some of the higher-cost alternative products that exist on the market. Part of the purpose here is about using policy and government intervention, quite frankly, to influence the prices and the products that are on the market. It's in some ways the Walmart effect, if you will. This account, what we have nicknamed, although I'm looking for other ideas, the safety account, it would meet many of the transaction functions that you see with checking accounts, from point-of-sale access, cashback at ATMs, bill payment, online purchases, but without the risk of overdrafts, which are driving so many consumers away from traditional bank accounts, as well as without the impediments that exist with bank accounts as a result of check systems. Millions of consumers can't access bank accounts because they get into this 7-year period on this check system, which we could talk about if you have questions. It would also have an interest-bearing savings account, similar to the NetSpend card. And in order to initiate savings and to begin to facilitate it, some portion of that tax filer's refund would be automatically deposited into the savings component of this account. This is a big proposal. If you think about it, we have 134 million tax filers each year, and approximately 100 or 105 of them receive a federal income tax refund worth about $2,000, but that's actually a pretty conservative number, and it's pretty low relative to the incomes that lower income households receive. Of these 105 million tax filers with refunds, fully 60 million of them are getting those refunds via a paper check, and you heard John Thompson earlier talk about this. It just so happens that those households who are getting those paper checks are the very households who we're talking about today. They're the lower income consumers earning adjusted gross incomes of $30,000 or less. So using, again, very conservative estimates, that means each year that as much as $56 billion is flowing to lower-income households with AGIs of $30,000 or less. We think that by harnessing the significant pool of money that's going out on an annual basis from the Treasury Department on a paper check, that we can utilize that moment and that volume and provide a no or very low-cost financial transaction product, quite literally on the tax form, for those 30 million households. We intend also for this account as a policy matter to address the demand for refund anticipation loans. One of the big rationales for taking out loans is to get those refunds quickly, and we heard many of the really important reasons why households are needing those monies as fast as possible. This would basically reduce the time that it takes for those monies to be dispersed from a matter of weeks to a matter of days. So getting those monies into those accounts quickly. This idea, this proposal, would also save the Treasury Department, i.e. the taxpayers, millions of dollars each year by going electronic. That is saving 89 cents per paper check, where they, by doing it electronically, it would be a cost to the Treasury of 9 cents. This isn't it's maybe somewhat of a radically new idea, but it's not a completely new concept. Since last year, the Treasury Department, working with the Social Security Administration, has begun issuing prepaid debit cards for Social Security recipients to receive their Social Security entitlement payments into that transaction tool. And then I'm sure many of you heard 2 weeks ago, President Obama announced, this is something we're actually quite excited about and had advocated for, that tax filers will now be able to purchase U.S. savings bonds literally on the tax form. That's quite a big accomplishment, and it definitely sets a precedent for looking at the tax time moment and that federal income tax form as a means of delivering good financial services and products to consumers. So now turning to another proposal that we have. This is, you heard some of this as well. This is another problem facing many underbanked consumers, and there was a really pointed question, which I appreciate earlier, around identification and the challenges there, especially for more transient populations who maybe don't have permanent addresses, as well as immigrant consumers. While the regulations are actually highly flexible in terms of what it takes to verify someone's identity for an account, there's a lot of responsibility and liability that ultimately resides on the financial institutions for making sure that Melissa Coity is Melissa Coity. And as such, we don't have great data on this point, but there is a lot of anecdotal information suggesting that because of that flexibility and the combined liability, that institutions are having pretty strict requirements in terms of what it takes in identification to open up an account. By learning, again, from what we've seen in the money services business, where anti-money laundering strategies are largely carried out on the back end in terms of account monitoring as opposed to focused on the front end, what identification materials you need in order to open up the account, and learnings that have come from South Africa with their South African account, we've actually developed a policy proposal, what we're calling the passageway account. It is intended to literally be a passageway account for an individual who may not have the typical identification documents that are needed to get into the account, but they do have certain materials that are required by the IRS through the ITIN process, which I'm happy to talk a little bit about. But basically, by creating a tighter constrained account on the back end in terms of the balance of those accounts, the velocity of the money going into and out of the account. By controlling the risk there, we think we can issue and offer a lot more flexibility on the front end in terms of what the identification is that can get someone into one of these products. Another idea where we think we really want to see some headway made in policy is around the attention, or is around the need for savings. We know that underbanked consumers, as we heard today, want to and often are saving in time significant amounts of money, particularly for short-term precautionary purposes. However, we know opening a traditional account can be quite challenging for a host of reasons, whether that's a savings account or a CD. And the likelihood of making routine and regular deposits into a savings account can be challenging even for the most wealthy of us. So in order to understand really how policy and practice can help to facilitate savings for shorter term needs, we're testing a savings approach, what we call autosave, that initiates and streamlines automatic savings for short-term purposes through the workplace. This is a concept that my colleague Reed Kramer designed a few years back. The pilot, which is just getting off the ground, is examining a number of different approaches to enrollment that actually leverages the power of defaults, such as the type of the account product that's used, and one could envision at some point that a payroll or a prepaid card would be one of those, as well as items around the amount of savings that flows into those products. We expect that the pilot is really going to offer insights regarding how policy can help to influence both employers, the financial services space, industry, in facilitating short-term savings through the workplace. And we also think that we're going to get some really important policy insights around direct deposit, because clearly that's a key component of this. All right, the last one that I want to mention today is access to short-term, responsibly priced, small dollar credit. Again, you heard this discussed today. This is clearly another area in which policy intervention is warranted. Credit constraints is one of many factors are actually raising the cost of credit for those who can still access it, and it's reducing the access for consumers with less than solid or stellar credit scores. One policy option that we're considering for facilitating access, and I have to say, this is an idea that James Gutierrez, who spoke earlier today, has really been championing. But the idea is to facilitate access to well-priced credit would be to establish a federal guarantee program, which would basically enable large commercial lenders to provide liquidity to some of these smaller, small dollar lenders, who then in turn make well-priced products to consumers at a reasonable price. The price for admission, of course, in order to ensure that these are good products for the consumers, would be that participating lenders would have to incorporate an affordability test into their underwriting standards. In addition, any fees that are associated with the loans would have to be factored into the APR calculation. And you heard James talk about this, the importance of helping to build credit, to participate, the credit histories or the credit activities, payment activities of those consumers would have to be reported to one of the big three credit bureaus. This proposal does come with a sizable price tag, but we are inclined to think that with a well-designed program, it could help millions of consumers access some of these short-term small dollar needs. So thank you, and I'm now going to turn it over to Ed, and we'll go from there.
Thank you, Melissa, and I appreciate the opportunity to speak here today at the New America Foundation. Again, I'm Ed Merzwinski with the U.S. PIRG, and the work that we do is primarily lobbying, but we also do some research and policy development as well. On my biography, my blog is listed, and that's where I comment on all the issues I work on, plus all the other issues that I'm interested in.
Can we expect comments later on today?
Yes, and in fact, I have, like I say, a keen interest in financial issues, but on the blog I also talk about everything from intellectual property and the Google book settlement to military contractor abuses. So it's a pretty widely ranging blog. But I do appreciate the chance to talk about these issues today. I've been working in Washington on financial services reform for 20 years, and we have had our ups and downs. We're currently very excited about the opportunity to work with the new Congress and, of course, the new administration and the new president. It is nice to be working and playing offense at the end of the field and not just down at the goal line, defending our own goal against the unfair practices. But I want to talk about a couple of things and then talk about why I think the Consumer Financial Protection Agency is really a critical step forward that will help us to get to the goal that the companies that have talked earlier today, that the policy people have talked about earlier today, and that the consumer groups feel strongly about as well. First of all, there are a lot of unbanked Americans. When I was looking into speaking here today, I saw numbers that were much higher than the last time I looked at the statistics for the number of unbanked Americans. Banks have left people without bank accounts. They don't care about attracting lower income or moderate income customers. They only care about extracting money from people, and quite frankly, apparently they feel that a lot of people don't have enough money to extract enough from them. There are other issues, of course, involved. The terrorist and drug money laundering regulations that have been invoked since 9/11 and since the growth of drug money laundering have increased costs on banks and also made it more difficult for people to obtain bank accounts, as has been discussed. But there's much more to it than that. The mistakes in credit reports, the Check Systems Credit Reporting Agency, for example, prevents you from opening a bank account. The other credit reporting agencies, the ones you're more familiar with, prevent you from getting affordable credit. But Check Systems, you're in there, there's no way out. It's not like you have a good Check Systems report or a fair Check Systems report. You just have a bad one. Nobody has a good one. Nobody has a fair one. And so mistakes in credit reports are a problem, and so is the lack of credit reporting. If people have not had traditional credit, they don't have a good credit report because they don't have any credit report. So these are all barriers to the unbanked. The second issue, of course, is that in the absence of the banks serving everybody, we've had this tremendous growth in the fringe financial industry, the alternate financial industry, what's called today the shadow banking industry. And it's big business to make predatory loans to the poor. The poor still pay more. 40 or 50 years after the book, The Poor Pay More, came out, big business has really taken over for the small storefront stores that were chronicled in that book by David Kaplowitz in 1964. Now we've got stock-traded companies from Rent-A-Center to the various payday loan companies, Advance America and others, the car title pawn companies that take your car if you don't make payments. They don't just take the $200 that you owe them. They don't sell your car for $1,000, take $200 plus the fees. They take your whole car. It's just an astonishing underbelly of under-regulated financial services that is preying on the poor and low-income Americans, some of them with bank accounts who are underbanked and some of them without bank accounts. Then finally we have the banks have failed. I said the banks don't care. Well, they've also failed. They've also embraced what the predatory lenders are doing. And there's an example of that today. Senator Dodd, chairman of the Senate Banking Committee, has announced that he is going to join Representative Carolyn Maloney, our longtime champion, against unfair overdraft fees. And that gets me to my overdraft fees are essentially a bank-offered payday loan. They provide them as a quote-unquote feature of an account rather than something that you ask for. And this gets me to my fourth area. My fourth area, of course, is the regulators have failed to keep up with technology, and they've failed to hold the banks accountable. The regulators came out with a rule on the overdraft loans. They said, well, these loans are in fact loans, and they should be regulated under the Truth in Lending Act. But we're not going to do that. We're going to call them fees, and we're going to regulate them under the much weaker Truth in Savings Act. And we're going to allow banks to charge consumers $35 to not just write a bad check, but also to go to Starbucks and get a $4 latte and allow the transaction to go through even when the bank knows there's no money in the account, and then ding the consumer for $35. And even if they had the $4 in the morning, we're going to allow the bank to change the order of the checks that are cleared through the system that night so that they can get more bounces. So the regulators have failed miserably as well. And, of course, we already know the example that the regulators got the authority to go after mortgage predatory lending in 1994, and the Fed came out with its rule in 2008. Only after credit card anger grew to a crescendo, and only after Carolyn Maloney proposed legislation, did the regulators come out with their own proposed rules to ban the worst credit card practices. So it's a serious problem out there, and I'm encouraged that technology has enabled new companies to come in as niche operations that are growing bigger and that are serving the unbanked and the underbanked. Prepaid debit, internet banking, internet financial services, I should say, because it isn't always banking. These are encouraging trends. But the question is, are they going to become asset building, or will they morph into wealth depleting? Will these products have the worst aspects in the long run. I'm talking about. I'm not criticizing any of the particular products here today, but in the long run, will we develop a model where we have one set of people who have bank accounts with full consumer protection and another set of people who have bank-like accounts without as many consumer protections? They still have the fees that bank accounts have, but maybe they don't have the protections. And so I believe that what we need to do is figure out a way to go forward to add anti-fraud protections to the new products, fully legal anti-fraud protections such as Regulation E provides. I'm not averse to looking at modifying Regulation E if there's too much cost to paper transactions. If people have if people have computerized accounts, we'll consider looking at new ways to offer those guarantees. But we need Reg E protections. We also need deposit insurance. People may not be aware, but all these prepaid cards are not equal. Mobile banking and e-banking has not created cards with full deposit insurance in all cases. The regulators did move to provide deposit insurance on payroll cards, and I won't go into the details of when some cards have deposit insurance and when they don't, but not all the other cards do. So gift cards and other debit cards are just like cash. I think people think they're just like bank accounts, but they're treated just like cash. And I use a credit card on the internet all the time. I never use a debit card because the credit card laws are so much better. I don't have time to really go into the details, but trust me, the credit card laws are much better than Regulation E. Finally, because I know I'm probably over my time, I just want to say that all of these issues, I think, are resolvable. We have proposed a number of changes to make all payment card protections, all types of checks that people write, all mobile banking. When I say we, I mean the broader consumer community. And Consumers Union has a new report. I have a one-pager on it, and I have some other handouts I'll hand out at the end, and I'll put all these materials on my website and on the event website as well, because I don't think I brought enough. But we think that all of these problems are resolvable, and the place to resolve them is in the Consumer Financial Protection Agency. Instead of 7 agencies that regulate some of the bank firms in one way and the non-banks in a different way, one agency with one mission, consumer protection, is the solution. And we think this agency will have a strong hand when it comes to unfair products, and it will have a light hand when it comes to products that are going to be developed and that are going to be promoted to help people gain wealth. It's going to have a literacy component, which has been something that has not been adequately explored by the other regulators, and it is going to evenly provide you with protections. As somebody raised a question earlier, it doesn't matter where you buy your product will be regulated in the same way. And it's the fight of our century. Last year, the entire world economy collapsed because of a lack of consumer protections. An utter lack of consumer protections, regulator idiocy piled on top of that, caused the not just collapse of the mortgage market, but the ultimate collapse of the world financial markets. We're just now starting to recover from that, but I can tell you that there's amnesia on Capitol Hill. Not insignificant numbers of members on the Hill are listening to the financial services industry, which is using the Bart Simpson defense, which is, I didn't do it, it's not my fault, you can't prove anything. It was some other guy. And it is scary, but that stuff works on Capitol Hill with some of the people. And we need your help to go up to the Hill and fight back and urge Congress to pass a strong consumer financial protection agency that restores the law at the federal level as a floor, not a ceiling, that allows for all products to be regulated by one regulator so there's no regulatory arbitrage, and really protects consumers as its only mission. Thank you very much.
Thank you, Ed. And now we're going to turn to Bill Zavarillo. Bill is senior professional staff member of the U.S. House of Representatives Committee on Financial Services with Chairman Barney Frank's office. Thank you, Bill.
So, did anyone happen to catch Barney's exchange over the August recess with his constituent in the town hall meeting? So you'll understand then, as his representative today, I'm not allowed to debate any of the empty chairs in the front row. I want to start out minimizing expectations. I'm much more of a generalist, I'm sure, than everybody who's spoken prior to me. So instead of talking in macro terms, let me start by talking in slightly personal terms. My family grew up in Akron, Ohio, and our favorite son these days is LeBron James, which has nothing to do with the subject matter. I just like saying that. My grandfather was a rubber worker at Goodrich and bought a house in the 60s, for $10,000 or $15,000. And they lived there forever and paid off their mortgage. My grandfather died in the late 80s, and my grandmother lived there until her death, which was fairly recently. And within a year or two of her death, my grandma was this close to signing away her entire house. And but for the intervention of my mother, they would have just flipped it from her, because she didn't know what she had a solid investment. It was her entire sort of economic well-being, and because of what Ed's describing, a predatory pitch, she almost lost it. So she died, and she left the house to my uncle, who is disabled and can't work, has no money. And after we got done with a bunch of legal wrangling, I became the custodian of the house for him. And the first thing that he wanted to do when that was done was to respond to a television ad that would pay him cash for the house, which is already incredibly devalued, if you can imagine, in the middle of Ohio. He wanted to get $20,000. Well, thankfully, through no fault of mine, he qualified for SSDI after having been turned down twice, and so he doesn't feel the same pressure to sell the house. So we've been able to work with him to hold on to that. The point I'm trying to make is sometimes even when we make good decisions, bad decisions are right around the corner, and the lines are very blurry in this area. One more quick story just to illustrate this. My sister, who lived in Chicago for many, many years, is a teacher. Her husband was a part-time teacher, and they bought a house in, I guess, the middle, maybe early to middle 1990s, and kept it until a couple of years ago. So they saw a pretty good appreciation in their house. And they were running tight on money. They decided to move to North Carolina, and so they sold their house, and they sold it at an $80,000 appreciation. But when they moved, they had zero equity. And the reason is that they kept refinancing. And the banks kept telling them, you can get $20,000 here, $20,000 there. So again, they did a smart thing buying a house. They held it, it appreciated, but they ended up with nothing. Literally the day she moved, she called me because the mover, the estimate of the mover from Chicago to North Carolina was several $100s more than they thought, and she didn't have the money. And she had to ask me to borrow the money for her to move to her house in North Carolina. Finally, about a year after that, they decided they wanted to buy another house in Raleigh. And she happened to call me, and she explained the loan, and it was, free mortgage, right? No money down. And I said, Tracy, do me one favor, call Self-Help Credit Union. And I gave her the number, and she did. And thankfully, for once, she listened to her big brother. And she's got a house and a mortgage that's reasonable. So, what I'm trying to say, I have a theme in my head. I hope I can articulate this. I'm going to try to blur a lot of the lines of sort of the demarcate good from bad and all of that when we're talking about policy. For a long time, before I worked here, I had my first career on Capitol Hill, and including time on the banking committee, and the whole discussion, the answer was disclosure. That if we just disclosed information to customers or consumers, that everything would be okay. I think that when we think about disclosure, and even the word that Melissa used, access, it's not that simple. I mean, in some ways, I think consumers have too much access. The question is access to what? And, you know, the television gives too many people too much access to too much bad stuff. When before I came back to Capitol Hill, I see a lot of friends here, people. I worked for IDAs, I worked for micro loans, and one of the things that really works about those types of financial products is that it's not just money. It's counseling and training, and it's ongoing. It's not just putting, you know, we always like to say in an IDA that objective isn't to put somebody in a house, it's to put somebody in a house that knows what they're getting and knows how to manage it. And so there needs to be, and I don't have all the answers here at all. Ed seems to think the CFPA is the answer, and that's good. I hope that that's right. But somehow we need a set of over a period of time interventions, physical interventions with consumers, so that even if we, in a perfect world, set up structures and protections for consumers, that they can work through in their own minds what is best for them, that they can make personal decisions that are sensible for their sort of economic circumstances. The other day, we had a hearing at our committee on how to make the CRA more modern. And it devolved into a pretty idiotic debate about what caused the financial collapse, and many people were arguing that it was the CRA's fault, that the fact that we encourage banks and other financial institutions to do work in low-income communities and with low-income people somehow caused the problem overall. And I just, you know, I don't get to talk at these things because I'm just a staff person, but I feel like sometimes I just want to shout out, it's the product, stupid. You know, we came up with Congress devised a law to encourage banks to do lending and service in low-income areas, and that worked just fine over time. If you talk about conservative products, conservative mortgages, and it wasn't until, like Ed was saying, that companies started to figure out that wasn't enough money, that they can make a lot more money if they did some things really quick that were really unsafe and unsavory and illegal in some cases. And so we're sort of struggling with how do you expand access and protect consumers, and then hope that people make the right decisions for themselves. So that's the theory of the Consumer Finance Protection Agency, and Ed described it probably better than I could. If we can consolidate a protective consumer mechanism in the government, then we've accomplished the first part of the goal. But to me, I feel like even in a perfect world, let's say we establish a new CFPA and it's perfect, you know? Even, and this is what's hard about this topic when we talk about financial literacy and stuff. We can have all the consumer protections in the world, but we don't get to make every consumer's decision. And so there needs to be a way that people not just are offered options, but can truly understand what decisions are in their financial best interest in the long run. And that's hard to legislate. Ed talked about Senator Dodd was going to propose legislation to curb these overdrafts, and I looked at that and I thought, geez, you know, the rates that some of these overdrafts charge, I mean, makes you long for a payday loan. I mean, I would go further. I mean, seriously, it's unbelievable. And again, so this is where the line is blurred. These overdrafts happen in a mainstream financial institution. And we always talk about, oh, we want to mainstream the underbanked. Well, we do and we don't. We don't want that. Again, with the CFPA, if there's a way to safely lend people money, even if it's from what we're describing as shadow institutions, that's as important as getting someone into a mainstream financial institution where they might get taken advantage of as well. So anyway, I'll stop. When I was growing up, the peace protesters used to say, "Bread, not bombs." So I was trying to come up with a saying for us. And I admittedly, I only started thinking about this morning. So this is what I came up with. Best practices, not brochures.
Thank you, Bill. I by far had, I think, the toughest job of the day, which is really trying to hear what we've heard today, reconcile it, and try to think about how we put these really dynamic pieces and considerations together. But I hope what everybody got from today's conversation was a lot more information about this, who these consumers are, and that they don't get lost in the bigger conversations that are underway in your office. We have 5 minutes. Questions from the audience? Roy Sosa.
This question is for Bill on the, by the way, support 100% of what you said. And sometimes my only frustration is that laws don't get passed as fast as they need to be passed. And so I believe the job of entrepreneurs that care about the customers actually to develop the products. Because there may be a lot of gray, but founders of Bluebell Ice Cream once said, nobody ever got lost in a straight road. When you have a good product, you don't have a good product. But the question was, what's the right level of detail as you get into this? And an example for me is loans onto payroll cards, which we all agree payroll cards are good, and a lot of the proposals that New America Foundation have sort of say like, hey, reduce the cost of transactions, and payroll cards are the best because there's no fees, or there shouldn't be any fees, free and clear access to your funds. But when you say, hey, if you need a loan, we immediately think U.S., payday loans, overdraft fees, bad. But for example, in Brazil, payday loans are tied into the actual payroll, so the lender knows that the person that is getting the loan has a job, and so the loans are in the single digits, the APR, much lower than a regular commercial banking loan. And so there you have an opportunity for great things. But if you start with so this is like, where does the detail come? Because if you say, you pass a law that says no credit without X, this, and that, then it could potentially keep something that it would be very good from happening.
I think that's the heart of the question. I think there's a general recognition that, from the part of policymakers, that products need to be regulated. And the question is, how do you allow for good products, even innovative products, without going overboard? And I think there's a sensitivity to that. I mean, the industry spends a lot of time complaining about what Congress is going to do, that somehow it's Congress's intent to, set interest rates and that sort of thing. It's not true. It's really not true. I think that the sensitivity is to give sufficient flexibility and leeway to the regulator to make sure that really bad things are noted, but that safe products aren't. I wish I had a better answer.
Could I add really quickly that on the credit card bill, first of all, we didn't have any reform of the credit card industry in the first 19 years I worked in Washington. And in the last year, we finally did kind of get over the hump of this. The industry even prevented us from having hearings, let alone votes, on credit card reform. That's how much power they had in the politicized Capitol Hill. And in the end, we had to play this game of whack-a-mole, okay? The worst practices that they came up with, we were able to get Congress to specifically ban. I would much prefer to have an agency that's not going to run roughshod over everybody, but it's going to not be politicized. It's going to be outside the political circle, and it's not going to have 7 different agencies regulating these industries. Like if you're connected with your prepaid card with a bank, are you regulated in one way? Then if you're connected to a thrift, then if you're connected to a non-bank, I mean, so we're trying to depoliticize the thing and come up with an expert outside agency, and that's one of the goals, to answer some of these questions outside of the hot fires of the congressional debate system.
One here and one here.
This is such an interesting discussion, and Bill, I'll sit in those same hearings, but I kind of want to shout out, it's the greed stupid, as you're talking about whether it's Fannie and Freddie's goals or whatever. And this was the question that I asked Peggy as well, which was really meant to be at the heart of the CFPA. The concern that we have is, one, we think the CFPA really does fundamentally realign the focus of the federal level around consumer protection, which is absolutely needed. A concern that we have is that, and it's constructed, has checks and balances in it. The states, if there is that 12 years of inaction, that the states could do something. I'm really afraid, and I think this is where Congress is going, is that it becomes preemptive. And even if it is an independent agency, you can see philosophical capture, with the Fed, an independent agency, where they didn't do anything because of, a worldview. How do you balance that out? How do you maintain those checks and balances with a pure federal system, or can you?
Well, I'll just say, John, from the consumer groups that are working for the agency, and I've neglected to point out that along with many other consumer, civil rights, labor, progressive financial institutions, we are part of Americans for Financial Reform on the web at ourfinancialsecurity.org. We have a lot of paper up there on the work that we're doing. Over 200 groups are part of the coalition. But from our perspective, yeah, we're fighting that fight, and we don't want to lose that fight. If we make this agency preemptive, things are almost worse than they are today. And we have to maintain the Obama administration's preference to return to a federal law as a floor, not a ceiling. And Chairman Frank and Chairman Dodd have been, I think, emphatically in support of protecting and preserving the agency. They don't want it to be gutted or eviscerated. So, yeah, it's a tough question, but I don't think all of Congress is pushing that way. I think there are loud industry voices urging Congress to push that way.
At the risk of sounding like industry, which I'm not, I also think, though, that it really does beg the question of the issues of whether it's consumer protection or safety and soundness. When we're looking at the sphere of these non-bank financial services firms, how do we get better streamlined coordination between the feds and the states in order that we're enabling some of these innovations to happen? And I think that is an open question, and one that really does need to be thought through as we move forward.
Goes a long way in that direction.
Question over here.
It's more of an idea or an observation. I wanted to go back to, kind of the rhetorical questions that, Bill, you raised about, even if we put regulations in place, how do we help consumers make good decisions? And in my experience working in financial services, I've seen so many parallels with health, and in particular, weight control and obesity. And, in the United States now, more than 50% of Americans are overweight, and some, frightening proportion are obese. And we've done a terrible job at being able to resolve that problem. But I think there's a lot for us to learn in terms of the approaches that have worked and not worked in terms of food regulation. And yes, there are some things that we've determined are so dangerous that they are outlawed by the FDA. But then there are other things like, soda, candy, that are very dangerous, but they remain on the shelves and consumers have to make the choices. And so I think it's just, in a space that we all feel is very new and very gray and ambiguous, there may be some historical lessons to learn from the similar issue of trying to help people be healthy.
I think that's a very good analogy, and I think that because I was thinking the same thing on the way over.
All right, we are at time. I really appreciate everybody sticking around. I hope you did really glean a lot of information from today's discussion. Thank you for coming.
And